Let's say that rates are between 4.5 to 5.5. And corporate America is not ready for that.
We're slowly moving away from do we need to raise rates another time or not to how long do we need to hold here.
If you look beneath the surface, things are actually, I would argue, pretty good and getting better.
I'm not surprised that we can get a nice rally if we maintain the status quo.
There's evidence of capitulation in the way the term premium moved.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market negative by 0.1%. Your headline in the last 24 hours. The President of the United States, TK, heading to Israel.
There's no other story today. There's the bank story and the rest of it, the markets and all. But the President of the United States is basically traveling to a war zone.
Two objectives here. One, to prevent the conflict from engulfing the whole region. And two, Lisa, to help develop a plan to get aid into Gaza.
Which is basically one of the key components in all of the diplomatic talks that we've been hearing about with Tony Blinken, Secretary of State. One of the key concerns for all of the different countries in the region. I find it interesting that President Biden is going to be going to Israel and then going to Jordan right after, entering a zone with security issues as well as just strategic issues, how the U.S. is going to influence things.
I'm reading right now the Fromkin on the Turkish War and World War I, and it's amazing the parallels to right now. We are out front with diplomacy. We are jetting around. Somebody said to the Secretary of State, "Where have you been?" He said, "I really can't remember." And it's scary, the shadows to early 1914, as they tried to avoid a war, and they assumed it would be a short war. Now, the parallel's not there, but at the end of the day, it's a war. John, the Daily Mail in London today talks about the tunnel structure of Hamas, 40 feet underground, in maybe as many as 300 tunnels. That's the reality for the Israeli military.
Do you want the list for Secretary Blinken? Jordan, Bahrain, Saudi Arabia, Qatar, UAE, Egypt. As you indicated, he's lost count. The intensity of the diplomacy over the last several days, Tom, has been absolutely amazing to witness. And this uncomfortable tension hanging over the whole of the Middle East, as Lisa, seemingly we all brace for what could be a full ground invasion.
Although it's been delayed, and a lot of people are saying that it probably won't happen when President Biden is in Israel, that they are unlikely to make that ground invasion. That said, what is next? And what's the plan afterwards? And how do you avoid this becoming a conflagration with some pretty fiery words coming out of the Iranian government? And that, I think, is one big concern.
Yeah, that's going to be there. And I get the idea that there's diplomacy and we're going to wait to Biden, but I don't hear enough about the Israeli military, nor should I, because they're not doing this for the media. They're not doing this to send messages. They have to prosecute a war, and you do that in secrecy.
Much more on this throughout this morning on Bloomberg TV and on Bloomberg Radio. Plenty on the markets as well. Equities a little softer on the S&P 500. If you're just joining us, we're negative by 0.2%. Yields a little bit higher by 5 basis points, 475.21. Bank earnings, economic data, Bramo, and a ton of Fed speak all coming up later today.
Will it have any predictable effect on the 10-year yield? We have no idea, because it's been bouncing around like a ping pong ball and will likely continue to do so. Today, what we are looking for in terms of the economic data, 8:30 a.m., U.S. retail sales for September, really key to try to understand just how much extra powder the American household has to keep fueling this rally. We have seen a deceleration in spending from highly elevated levels. Does that continue, or do we see a sort of leveling off? Fed speakers, they do really come to the fore today, as they have been all week. New York Fed's John Williams, Fed Governor Michelle Bowman, Richmond Fed President Tom Barkin, Minneapolis Fed President Neil Kashkari. What is going to be the message at a time of great uncertainty? I keep going back to this. I mean, what can they possibly say to create more stability in the long end, if that's even what they want, or is this actually what they want? I don't know. And then also we get earnings today. Bank of America and Goldman Sachs coming out this morning before the opening bell, 6:45 a.m. and 7:30 a.m. respectively, about. After the bell, United Airlines and Netflix.
Oh, interesting.
Our earnings in the 4. And that, I think, was going to be one of the key messages. Are earnings going to take precedence over this cloud of uncertainty that seems to be swirling over all the geopolitics?
We saw it in lift of the market yesterday. John, I would notice, first thing I noticed this morning is Euro Swissy, really an abrupt, strong Swiss franc through 0.95. A lower number is a stronger Swiss franc. Is it germane? No, but finally Swiss franc moving.
I'm focused on Goldman Sachs in the next hour. Headline story, Financial Times. Brahma knows where I'm going.
100%.
According to people with knowledge of the decision, Goldman's chief executive David Solomon has decided to stop DJing at high-profile events following criticism that his hobby created a distraction from his work leading the Wall Street firm. Is it a coincidence that this story's come out the night before, the day before we get earnings from Goldman?
Did you see the pushback from Goldman Sachs where they were saying he hasn't done a high-profile DJing affair for a full year, so stop it already? This is basically, what we should expect. But yes, to your point, how
so
does he
it's not
shore
retired, just sort of semi-retired.
Well, how does he?
It's a hobby at home now.
Okay, at home, can you imagine DJing?
Not in the Hamptons, TK.
Yeah,
well,
the way I look at it is Adam Richard Wiles is breathing easier this morning, and the answer is one day Tania comes to me. And she goes, "This is the Queen of Asia, folks." Tania comes to me and says, "I did it." And I said, "You're interviewing Calvin Harris." Blank stare. I have no idea what's going on. And what a privilege it was to interview Calvin Harris and not have a clue what I was talking about. He's breathing easier today because DJ whatever is not in the game.
Just to be clear, you're referring to our old producer who's called Tanya.
Yeah, Tania. Yeah. But I'm also referring to Calvin Harris, who's some DJ guy.
Levels of inside jokes.
Have you seen Calvin Harris?
Yes.
Did you go see him?
No, I haven't seen him in real
stadium
life. No,
and
I haven't done that. Did the interview go well?
I have no recollection because I was scrambling.
I don't know how we ended up here.
There's like 4 kids in my ears going, ask him about this, ask him about this.
Okay. All right, we can reflect on that.
We'll do better with Jonathan Stubbs.
I hope so. Jonathan Stubbs joins us now, equity strategist at Berenberg. Jonathan, good morning to you. Just what is a kangaroo market?
Well, it kind of feels like we're in a sort of everything, everywhere, all at once market, and we go to sort of kangaroo market mode. We wrote about this first this year in April, when we sort of see markets being sort of long uncertainty and risk and short conviction for an extending period of time, and when that happens, we find sort of upside quite hard to make a case for. And we see sort of markets generally heading sideways with a sort of downward bias. And I think there's some very big sort of structural forces which support that at this time in an extending period of kangaroo markets. Historic debt burdens, a historic rise in rates we've seen, and also a historic sort of shift geopolitically that is obviously a key sort of feature of today's world.
So nothing can tame the kangaroo and calm it down. There is a question, though, going forward about what kind of structural aspects you're talking about and how you take advantage of them and not just be susceptible to the jumpiness, which some people really draw parallels back to the 2020 at the peak of the pandemic.
Yeah, I think that's important. This is not an outright bearish call at all. That's 100% right. So we explore the upside persistently, and we've done a lot of work looking at sort of liquidity, looking at earnings, which are the two main supports for upside risk. But find on both counts it hard to make a bullish case for liquidity, which probably needs a macro shock first to come through, or for earnings, which needs a sort of the macro conviction to shift towards recovery mode, which seems at least a couple of quarters off. So I think the sort of the good news support, liquidity or earnings, is quite hard to find. And so we then go into sort of various active strategies, active hedging strategies, we call them. We run a lot of sort of sector pair trades. Some of our sort of core ones over the last few months that we're still running are things like long autos, short luxury in Europe, long energy, short industrials, or short technology as well. These are sort of often quite contrarian. They lean very heavily on valuation. But those are the sort of sector trades that we go into when we sort of see these sort of stickier markets.
Jonathan, I just looked at World War II. And of course, John knows when I do that, I look at the Dow Jones Industrial Average going from about 115 to 180. In World War II, the Dow was up 55%. Do you just assume that the stock market doesn't crater given geopolitical tensions?
Yeah, I think it's hard to draw sort of parallels through different times. I mean, one of the starting points I have today, regardless of what sort of genre of topic we're discussing, is what I call this of the market's MXM score. So when you take the market's multiple, the first M, and the market's margin, and you sort of combine that as a single score, what type of equity market are we looking at? And globally, that MXM score is at the highs of the last 30 years, excluding the post-COVID bubble that we saw. So we're at the highs that we saw in 2000, 2007, start 2020, we're back to those levels, which tells us that from a corporate perspective, valuations and margins are still very high. So it doesn't mean equities can't go up or can't go up a lot over the next sort of few years for whatever reason, but the starting point is quite challenging in the first place. So I'd bring that context into that discussion as well.
What should we look for in earnings? I mean, I know you're taking a more holistic and global look. We're completely focused on bank earnings here today, but what are you looking for in earnings? Is it at the top of the income statement or margins down below?
Yeah, I mean, banks the world over had pretty sort of reasonable to strong support from earnings momentum over the last 6 to 12 months to help them in Europe, in particular, to be one of the leading sectors over the last sort of 2 quarters. More broadly, when I look at earnings, the first thing I think of, and we've talked about this briefly before, is what is the nominal growth opportunity that the global economy is giving companies? That's kind of the main feed for sales growth and revenue growth. And this year in the US, in Europe, nominal growth is going to exceed 6%. Next year, economists think it's going to be below 4%. So if we go from this year to next year, we've got sort of a 250 basis points drop in sort of nominal growth in US and Europe. And I think to start with, that introduces some headwind into the corporate sector. The second line, very briefly, is a lot of the sort of lead indicators, both sides of the pond, continue to suggest headwinds for earnings and margins as we go into next year. So this is part of the debate that goes into, can we build a strong support for earnings recovery into 24? I think it's premature to do that at this stage.
Jonathan, when do stocks become highly susceptible to bond yields in a way that perhaps is a driving force? Yeah, we've written a couple of notes on that recently, and we've seen a historic drawdown in bonds. If you look at sort of 30-year US, 30-year UK, I mean, we're sort of almost 60% down from peak levels there. So we've seen some very aggressive losses for institutions around the world coming through supposed to be risk-free asset classes. What that's done to the equity relationship is, if you take the US, for example, the NASDAQ or the S&P offered investors a 500 basis point yield pickup by owning NASDAQ or S&P from a free cash flow yield perspective relative to risk-free, relative to 2-year, pre-COVID and post-GFC. Now that's down to flat, so 0 for the S&P and minus 200 for NASDAQ. So again, the starting point for capital or a dollar coming to the market, it now has a competitive spread of asset classes from credit to sovereigns to equity to gather that yield. So equity will have less of an exclusive call on capital coming to the market. Effectively, the free ride is over. Again, it doesn't mean equities can't go up, but the free ride that equity markets enjoyed for much of the last of 10, 15 years, it seems to have come to an end.
The easy money. I wish someone had told us it was easy at the time, John, because at times it didn't feel easy at all. Jonathan Stubbs there of Berenberg. That phrase frustrates a lot of people, Bramo, the easy money. Did it feel easy?
Has it ever felt easy?
It never feels easy.
No, and especially right now. But I would argue that a lot of people were calling for the end of the world, frankly, when we were full of low rates and saying that it was going to create bubbles and it was all going to come down crashing. No. Hey, pipe down over there.
Let's talk about what hasn't been easy.
Let's do that.
This year, the bank stocks. You strip out JP Morgan. Bank of America's down almost 20% year to date. Goldman's down a little more than 8% year to date. This hour, B of A earnings. Next hour, Tom, Goldman.
We can't say this enough. John, I looked yesterday at a representative small bank. It was a bank around the corner from the $1 Million Cowboy Bar in Jackson Hole. I looked at a regional bank that my family's somewhat related to. They have a stadium out there in the Midwest named after them. And I looked at JP Morgan, and OMG, are we deluded by what we see from Fortress Diamond and Park Avenue? We got to mention this more and more. It's been carnage.
Well, to build on that, how much are the Jamie Dimons of the world getting more and more separate from the regional banks that you talk about? The divergence just simply growing as the haves
and the
separate
technological
from the have-nots.
Divergence. Everybody go 1, 2, 3. E.F. Hutton. The technology lead of these banks is extraordinary.
The relative underperformance of everyone else versus JP Morgan has been amazing to see this year. Coming up, Thomas Show, the KBW CEO from New York City this morning. Good morning.
Thursday, the Economic Club of New York hosts a conversation between Fed Chair Jay Powell and Bloomberg Wall Street Week's David Weston. Recession risk, inflation outlook, real estate amid high rates, and more. The live interview happens October 19th at 12 p.m. Eastern on Bloomberg. Context changes everything.
On Wednesday, President Biden will visit Israel. He's coming here at a critical moment for Israel, for the region, and for the world. First, the president will reaffirm the United States' solidarity with Israel and our ironclad commitment to its security. Second, President Biden will underscore our crystal clear message to any actor, state or non-state, trying to take advantage of this crisis to attack Israel. Don't.
The President of the United States is heading towards another war zone. Antony Blinken, the U.S. Secretary of State, speaking in Tel Aviv. Live from New York City this morning. Good morning. Welcome to the program. Busy 36 hours coming up. Your equity market on the S&P negative here by 0.2% on the S&P 500. As Bramo indicated, the next day or so looks a little something like this. This hour, Bank of America. Next hour, Goldman. Tomorrow, Morgan Stanley. Then after the bout tomorrow, TK, things start to pick up with Netflix after the close. It's tech just around the corner.
Tech on to Apple. I believe it's November 2 after that Fed meeting, and it's going to be critical. And it's just very, very importantly, John, you've got Apple, the mystery, that Bloomberg article yesterday, OMG, iPhone sales are slower in China. And the stock really didn't, react. I mean, I don't know what to say. It's going to be, to me, it's a complete mystery.
Well, Mandeep Singh, I caught up with Mandeep Singh over at Bloomberg Intelligence, and he said it's too early to really tell what's happening with the iPhone for Apple in places like China. We're talking about data that backs up 17 days. Got to talk about a whole quarter. But if that weakness is pronounced, Tom, I'd go straight to the idea, what is it? Is it weaker consumer sales trends? Or two, is it competition in China? Now, TK, if it's competition, even if you get a rebound in the country and the economy, that competition could be real. And we'll find out if it is in a few months' time.
We're going to find that out, and it's going to be interesting to see Lisa leading our coverage there on earnings season as it is. Later today, I'll have the honor of speaking to Admiral James Stavridis and all of his experience with NATO and with the United States Navy. A few years ago, it was my book of the summer, I believe, was 2034, which was a gentleman from the Navy and a gentleman from the Marines. Elliot Ackerman is U.S. Marine Corps veteran, former White House fellow, and of course the wonderful must-read 2034 about the South China Sea. Elliot, the reality here is many pontificate, many talk. For example, at the 1st Battalion, 8th Marines right now, if they were in Gaza, what would your regiment be doing?
Well, we fought in Fallujah, and right before that battle, we were basically dug into slit trenches on the outside of the city in the rain, just waiting to get the order to go in and launch the assault. So I assume there are, many, many groups and regiments of Israeli soldiers and infantrymen who are sitting in the exact same position right now, just waiting to get the order to go into Gaza.
What would you think is the plan? And I say this listening to Ben Hodges, General of the Marines, or Mark Kimmett as well, their fear of urban warfare. So what will be different here from your experience in Afghanistan and in Fallujah?
It's tough to overemphasize how costly and gritty urban combat is and how much it takes away whatever technological advantage that you might have. I mean, this is the type of combat that is fought room to room, house to house, block to block. The analogy I would say is it's the equivalent of being in a knife fight in a telephone booth. Very, very close quarters. And that is the type of fighting we will see in the weeks and months ahead in Gaza if the Israelis launch a significant ground assault.
There's been some discussion that the Israeli army has held off on that ground incursion for a number of reasons, whether it's weather, whether it's conditions, whether it's prepping, but also that ultimately they may not. They may choose some other means. They were hinting at that overnight. Do you think that is a likelihood? Do you see another way other than what you just laid out?
Well, there's certainly a logic behind it. Hamas knew what they were doing when they launched these attacks, and so much as that these attacks were designed to be a provocation. And the most obvious move would be for the Israelis to go into Gaza. And Hamas knows that once the Israelis go into Gaza and that battle begins, immediately, and I think quite quickly, political support internationally for the Israelis is going to begin to wane, because the images that are going to come out of Gaza are just going to be as brutal as anything you can imagine. So the question that's obviously posed to the Israelis is, how do we accomplish our objectives, which is the degradation of Hamas, without being baited into this really brutal urban fight inside of Gaza? And I'm certain that Israel's leaders are, weighing that and looking for other alternatives of how do you degrade Hamas without having to fight this battle. And if they feel that they can find that through limited strikes, by degrading Hamas's leadership, or by some of these raids we've already seen to the outskirts of Gaza, they're going to take full advantage of that. And we're just going to have to wait to see what they do in the days ahead.
A lot of people have described this as essentially another proxy war between Iran and the U.S., between Iran and Israel, and see that as the sort of big question mark. When does Hezbollah get involved? We've seen sort of some of the overnight tit for tat one day after another. How do you understand when that's become a full-blown new front, this war?
That goes to the purpose of the president's visit, the purpose of the deployment of 2 U.S. carrier battle groups to the region is to provide a very, very strong deterrence against Iran launching a broader war from the north with Hezbollah. So I think right now what you're seeing is Hezbollah and the Iranians are testing the type of response they'll get not only from the Israelis, but from the West. And I think thus far, we've provided a pretty resolute response. But that is obviously the big question, is how much does this war become a contagion in the region?
Elliot, without your experience, it's hard to understand how meaningful some of these headlines that come through actually are. Allow me to share this with you from the Wall Street Journal. According to U.S. defense officials, the U.S. military has selected roughly 2,000 troops to prepare for a potential deployment to support Israel. I should add that in the story, they say the troops are tasked with missions like advising and medical support. They're from across the U.S. Armed Services. They aren't intended to serve in a combat role. No inventory have been put on a prepare to deploy order. Elliot, from your perspective, with your experience, how meaningful is a story like that one?
Israel is one of the United States' closest allies. We already have cross-military partnerships with them. So I think this is really just an effort to bolster those partnerships. I would be very surprised if you saw any type of meaningful deployment of U.S. combat troops into Israel, because one of the things that the Israelis have been known for decades, really since the founding of the nation, is that among our allies, they are a country that does their own fighting. They do it for themselves. They're not reliant on the U.S. But that being said, we provide them with equipment and resources, and I would imagine many of those troops are going to be just enablers as the Israeli military gears up for a very, very large-scale operation.
How risky would it be to put U.S. personnel on the ground in Israel, given the conflict that you expect to materialize?
Well, if the U.S. did do this, and again, I doubt that we would, at least in the near term, given current conditions, it's a significant escalation, because then you do start getting into real wars by proxy, and you could see a response from the Iranians by putting in their own trainers inside of the conflict as well, whether those are Hezbollah fighters or members of the Iranian Revolutionary Guard and Quds Force.
Elliot Ackerman, thank you, sir. Let's catch up again soon. Always fantastic to hear from you. Marine Corps veteran Elliot Ackerman. I should add, in that story, they also say this, Tom, it's unclear under what circumstances the US would deploy the troops or to where, but the Pentagon decision signaled it is preparing to support Israeli troops should Israel launch a ground incursion into Gaza. That's about all the detail we've got at the moment.
Yeah, I think there's not much detail there, and the answer is logistics and moving stuff around and maybe intelligence as well. I really can't say enough about everybody pontificating now. I'm as guilty of this as anyone, John. And people like Mr. Ackerman, who, this is a key phrase, served multiple times. This is not some guy that dashed into combat and once got a ribbon and dashed out. It's 1, 2, and 3, and 4 efforts of high combat battle, the kind of experience we need to listen to now.
We've got to lean on the experience of those individuals to try and get some clarity on some of the headlines that are coming through over the last week or so. Busy morning for you. We're going to turn to the economic data in a couple of hours. Retail sales just around the corner. Sarah Hewen of Standard Chartered is going to break that down for us. Then a little bit later, this hour, 20 minutes away, you'll get earnings from Bank of America. Next hour, Goldman Sachs, your equity market, negative 0.2% from New York. This is Bloomberg. Coming off the best, a day of gains on the S&P 500 in about 10 days yesterday. Decent day of gains on the S&P and the Nasdaq too. Futures look like this. We're negative by 0.2% on the S&P. We're down by about 0.24% on the Nasdaq. Yesterday's gains, even with a sizable move higher on bond yields. Your Treasury market right now, 2-year, 10-year, 30-year looks like this. 30-year up by 6 basis points, back through 490. Over the last week, the smallest move on a 30-year yield in either direction has been the almost 10 basis points higher we saw yesterday. Tom, can you believe that? The almost 10 basis point higher move yesterday was the smallest move we've had on a closing basis on a 30-year over the past week.
But we're grinding, and it's not even a grind, it's more dramatic than that, out to a 476 10-year yield. You put another couple days of this together, and it's interesting. I'm going to correlate, John, your yield observation, which I think is dead on, with what I see with Swiss franc strength, and I would bring it over to EM currency weakness. I take the ratio of, John, too much math, ratio of the percentage change of the BBDXY versus the DXY. So it's basically blended EM added, China added currency versus DXY, and it shows the emerging market nicely weaker here. It's like a Damien Sassower.
I'll try and make it simple. Dollar a little bit stronger this morning.
Well, not only dollar a little bit stronger, but major partners a little bit stronger.
Just in case you lost anyone, that's all. I'm just here to make it simple as I possibly can.
Oh, here's Sassower. Oh, I lost Damien Sassower.
Let's go through the rest of fixed income. 2-year, 10-year. 2-year, sneaking back through 5.1%. It's up by a basis point this morning. For most people, the Fed's put a lid on the front end, all the flexibility, all the larger moves, Lisa, down at the long end. And Bramo, you see that again this morning with a 10-year at 476.
Which is the reason why I do wonder what the Fed speakers are really going to tell us with all of them lined up, because right now people have faith that they're going to pin the front end. They're not going to move that quickly. It's really the long end. And do they really have control? I don't know, but we are seeing volatility, unlike what we've seen since March of 2020. Retail
sales 2 hours away. I want to finish on crude, WTI and Brent. This story came out yesterday. It's not been talked about enough. Venezuela's government will resume talks with the US-backed opposition, which could potentially clear a path for the administration here in America to ease some sanctions on Venezuela, including, Lisa, drum roll, guess what? Oil production.
If someone were skeptical, just saying theoretically, if someone were skeptical, this is coming at a time where there are a lot of questions about if there are tensions that erupt in the Middle East and there are some curtailed supplies. Where will the U.S. get some potential, peripherally supplies? Excuse me, I'll get it out. I'm dealing with a Tom Keene pronunciation morning, but this is going to be the
wrong side of the table. Move over here. It gets worse.
I'm going to blame him because why not?
Strongest tea case.
Okay,
what is her problem today? Please help me.
Pressure valve. Javier talked about a pressure valve, and he said there's been 3 levers that this administration's been able to pull. Drain the SPR, 1, done that. 2, have a cozier relationship maybe on a relative basis with Iran, attempted to do that, that's broke down. So option 3, potentially ease sanctions, Tom, on Venezuelan crude. It's the latest in the last 24 hours.
And frankly, at IMF in Morocco, this was there. The ESG climate was suppressed. It was there. It was visible, but boy, was it changed from previous meetings. The answer, some would say, is just go out and find more oil.
Brent crude right now, just south of 90, positive on the session, 89. 87. Under surveillance this morning, President Biden travelling to Israel on Wednesday in a show of solidarity amid the country's war with Hamas. Secretary of State Antony Blinken brokering the trip after days of shuttle diplomacy in the region. Biden will also travel to Jordan later this week, making it the president's second trip, Lisa, the second trip to a war zone after going to Ukraine earlier this year.
There are a lot of questions around this. First of all, what kind of security would be required to have a sitting U.S. president go to a war zone and then go to Jordan, the neighbor next door? But number two, does this reflect a certain feeling of franticness in the administration, that they're running out of daylight, they're running out of time to prevent a wider altercation? I mean, all of the different nations that Tony Blinken visited, it was 4 in one day, I believe, at one point. Is he making headway? Can we get a sense that maybe this is the last show of resolve and support to try to stave off a broader altercation?
Big trip for the president coming up tomorrow. Let's turn to the rest in Washington, D.C. Here's the other piece of news. Congressman Jim Jordan of Ohio looking to become the next Speaker of the House with a vote at noon today. Jordan emerging as a front-runner after Majority Leader Scalise withdrew his bid last week. Jordan expected to move forward with today's vote despite holdouts in his own party. He can lose no more than 4 votes against United Democrats. TK, are we actually going to get this done a little bit later?
I did the math. I think I was on an airplane somewhere, and I actually did 4 divided by 200, whatever it is, and I came up with he's got a 1.8% margin of bodies. This is a razor-thin whipping.
TK.
It's not 4%. With McCarthy, it was 4%. With Jordan, the math works out to 1.8%. It's much thinner margin.
But peer pressure is an amazing thing, and that seems to be what we are hearing about within the Republican caucus.
Peer pressure.
School. I mean,
but the summary of this, seriously, the summary of this is the gentleman from Ohio had a good day yesterday. That's the basic summary. He moved the needle a little bit.
Getting closer.
Yeah.
We'll see what happens down in Washington
What
a little
else?
bit later. On Wall Street, bank earnings continue with Bank of America reporting perhaps in the next 15 minutes or so. Next out, Goldman Sachs, expecting those numbers around 7:30 Eastern Time. JP Morgan, Citi, Wells Fargo, all reporting better than estimated results just last week. If you're looking for Morgan Stanley, they'll round out the earnings for the big banks tomorrow. TK?
I don't have any wisdom on this other than what a shock. JP Morgan did well. There's some concerns here. Bank of America, bonds, Goldman Sachs, Marcus, and a whole host of
That
other
stock,
things.
B of A, has been bullied by the Treasury market.
Yeah, nicely said.
I've asked this question a few times of bank analysts. What would it take, Lisa, to get Bank of America out of the penalty box other than a big bond market rally?
I don't know, because from a fundamental perspective, they've been doing pretty well. If they come out and show the same kind of record net interest income, that they're actually having better performance of their loans than people expected, is that enough? I don't know. We haven't seen amazing things from stocks, even JP Morgan, after they outperformed dramatically.
JP Morgan up on the year by about 10%. Everything else, Tom, down, down, down. B of A, Goldman, Morgan Stanley, Citi, all negative by close to double digits for the year so far.
And what I'm going to do, and you're going to hear this when the earnings come out with our vast knowledge here, is to look at the book value, John. I'm doing it right now on the Bloomberg Professional Service. And John, you can do this with a book value at JP Morgan of 1.5 and a book value at Bank of America of 0.8. It's basically trading. Fortress Moynihan is trading at near half the value of Fortress Diamond.
How does Moynihan close that spread?
Work?
Don't know. It's a question for the analysts later on this morning.
Let's move forward here before we get ready for Bank of America and to give Global Wall Street our analysis of that. Sarah Hewen joins head of Europe and America's research at Standard Chartered, noted for really wonderful, elegiac, and thoughtful notes. I love your phrase for Europe and maybe arguably for the world of nascent disinflation. That perfectly captures the uncertainty out there right now. What are you looking for in the coming days where nascent disinflation becomes a true vector of disinflation?
Yeah, we've seen a lot of ambivalent data, and I think in particular different focus in the US compared to Europe. So in the US, we've had a mix of inflation data. Goods prices are falling, import prices are falling. Average earnings growth has come in low for a couple of months now. So this is all very positive, but we're seeing a pickup in shelter costs, a pickup in non-shelter services costs, and that's something that policymakers are going to be keeping a close eye on. I think across here in Europe, it's a different concern. UK, obviously, our average hourly, weekly earnings growth is still very high. Bank of England doesn't seem to be too stressed by that. They're looking at a range of indicators for the labour market, which I think they read as pointing to softness over the coming months. But 7.8% wage earnings growth is still high. Similarly, in Europe, recession looks to be the theme, but wage earnings growth is still too high for the ECB.
For our American audience, Sarah, let's do Hewen 101, which is the real economy of Germany, very weak. We all know the story. Do you extrapolate that out across the entire continent, or is it discrete to Germany?
There are particular features that are affecting the German economy at the moment. The weak trade environment, of course, for Germany, trade is an important driver of growth. The nature of the slowdown in trade as well, which particularly affects Germany. But there are other features which are more common to Europe as a whole. Tighter financing conditions. We've seen the long end rise of yields, and that's really compounding the policy tightening that's been taking place over the past year or so. Generally softer sentiment. The good news, of course, has been on energy prices, but we've seen gas prices backing up again and still somewhat higher than they were before Russia's invasion of Ukraine. So there are some very, features in common. Some economies are much more reliant upon imported energy. Others can rely more on domestically generated energy. So those are the sorts of differentials that we're looking at. For Germany, energy-driven industry is a big deal.
That's on the European side. On the U.S. side, it seems like everyone is completely divorced from those trends, basically saying, but we just keep spending. And we're going to get retail sales in a little less than 2 hours' time. We're also going to get Bank of America earnings in about 5 minutes' time, which will also give some light. Is there going to continue to be this resilience as people do what they do best in the U.S., which is shopping therapy?
Well, the resilience, I think, has taken a lot of us by surprise, and there seems to be a story of drawing on savings that were built up during the pandemic. So if we if we look at what's happened to savings, the drawdown in savings, that cushion seems to be disappearing, particularly for lower income households. At the same time, we're seeing higher debt servicing costs. It's just the very early signs of debt distress at the margins. All of this together would suggest that consumers are going to be reining back their spending. At the same time, though, inflation coming down, earnings growth is still a little bit higher than inflation. So in real terms, wages are rising. That is supportive. And as long as the labour market is holding up well, all the signs point to a strong labour market still, it's difficult to imagine that the U.S. consumer is going to stop spending.
So does that mean that the U.S. can continue to outperform Europe well into next year?
It certainly feels that way. We do expect that there is going to be a slowdown in the US, but it may take longer to come through. Whereas in Europe, certainly in the euro area, certainly in Germany, we're seeing very clear signs of quite a dramatic slowdown at the moment.
Sarah, thank you. Sarah Hewen of Standard Chartered. As we start to see evidence of that slowdown, guess what? America's getting back to the office. The latest headlines from the Census Bureau Household Pulse survey read as follows. Fewer than 26% of US households still have someone working remotely at least one day a week. The pandemic peak, 37%. The data for state to state, Connecticut's work from home rate has fallen to 28%. The peak in 2021, 46%. 46%. That has come down dramatically.
Well, and it makes sense because right now you've got a lot of people who are saying get back to the office, and you have other people saying, well, you're just bankers and you have a lot of commercial real estate investments and you want to prop them up. But other people are saying, no, actually, people are more effective in the office. It's been a battle, and workers are definitely losing some of the upper hand when it comes to, staying at home.
Maybe there's a trend there, but Nicholas Booth wrote at length on this yesterday or the day before, and I'm just completely ambivalent. My head is spinning for wise things to say about where we are 1 year or 3 years, John, or 5 years. What I can say is I did not sense this in London. I didn't sense work from home in London like I do here.
Well, you did choose select hotels that maybe didn't experience the country in quite the same way.
I was, you were out in the Cotswolds, is that how you pronounce it?
The Cotswolds, yeah. I wasn't there, but I wish I was.
Yeah, but...
Right now, too. I want to share this stat with you, Tom. Average ridership along the Metro North train lines that link the state to New York City and the offices has risen to a peak of about 70% versus pre-pandemic levels. It was 20% back in 2021. That's nuts.
Yeah. Paul Sweeney is genius on this, and he said this Monday, 24 hours ago, was a sea change. at 59th Street in Lexington.
Bank of America numbers just crossing a Bloomberg. We'll bring you them next from New York City this morning. Good morning. Numbers from Bank of America just crossing a Bloomberg terminal. The numbers look like this. It's an upside surprise after an upside surprise. If you're looking at things like third quarter trading revenue, that comes in better than expected. Investment banking revenue over at Bank of America, that comes in better than expected. If you're looking at net interest income for the third quarter, that comes in better than expected. The stock just a little bit higher by 0.2%. Some commentary from Brian Moynihan here, Lisa, the Bank of America chief executive. The consumer is starting to slow. Describes the third quarter as healthy but slowing. A healthy but slowing economy, Lisa, for Bank of America. That stock up by 0.2%.
What do we do with this? You know, people, traders, all of us like some drama, like either things are great or things are terrible. Not this muddle through. I mean, U.S. consumer spending, Moynihan was also saying, is still ahead of last year. So it's not as though we're slowing from a low place. It's not like we're heading toward recession. So how do people deal with slowing but still solid growth at a time when their revenues are increasing, at a time where their deposits are increasing, coming in higher than expected, at a time when they're still able to lend?
To your point, what are we going back to? B of A, the stock just a little bit firmer in early trading in the pre-market. TK, here's a number for IB revenue, 1.19 billion. The estimate, 1.11. Just a series of small beats here.
Yeah, that's exactly what I was going to say. I look at each headline and I'm like, small beat. Maybe it's being managed, but the gloom, not the gloom, but the angst that's been out there, maybe at least now on first blush has been pushed aside.
To Lisa's point on the consumer, Tom, consumer spending still ahead of last year. Things are healthy but slowing. What is the takeaway that you take from the banks we've heard from so far? B of A, JP Morgan last week.
My take is the banks are not homogenous right now, and I'm as guilty of this as anyone. I'm looking at 6 banks and going, this is the industry, and it's just baloney. There's a whole industry out there troubled.
My take is they don't know either. And they're trying to massage a message at a time where they're banking record net interest income. Bank of America third quarter net interest income, $14.53 billion versus the expectation of $14.2 billion. Yes, small beats, but beats nonetheless. So slowing, things aren't going to be perfect, but maybe kind of confirming the soft landing.
And provision for credit losses, kind of in line with what we heard from series of banks last week, including JP Morgan. Provision for credit losses, 1.23 billion. The estimate, 1.3. That's why you don't want an upside surprise, Tom. More provisions for credit losses. If you're really worried about the future, that's where it would show
I'm worried about the next quarter. I said that yesterday. I think this quarter is a breathing quarter, and you wonder about the bond market debacle. You wonder, and I think we'll see that in 90 days.
I don't think they can offer much clarity on 2024 at all.
Exactly.
This is like where we are right now. These are the risks, and this is the trend.
Yeah. What we're going to do is dive into this, and we have the perfect guest for you as well. I'm going to do a little math right now because Michaud will stick on the set if I do. Long ago and far away, up Route 7 in a bar in Vermont, Tom Michaud looked at logarithms, and he actually understands it's about relative change of where you are in history. He's the chief executive officer of Keefe, Bruyette & Woods. It is a Stifel company with KBW, and you know the acclaimed BKX index. I just looked at Bank of America. I went back to 2009, the gloom of 2009, and Fortress Moynihan is down 1.3-ish standard deviations on a log chart, which is where it's been before. Is it the buy of a lifetime because over 15 years we're where we are now in gloom?
There's an incredible amount of bad news in these stocks. You just mentioned one measure where these stocks look like, bank stocks look like they're off the charts. I could offer up several more. Relative PE ratio to the overall market is near a multi-decade low. But the one we published this weekend that got our attention the most is when you look at valuation to PPNR, pre-tax, pre-provision net revenue. So where you're taking out the credit expenses, and you just look at the core business. During the global financial crisis, the bank stocks trade between 4 and 5 times that number. We're currently trading at 5.5 times right now. So we've got that type of proportion in it. Meanwhile, JP Morgan this quarter earned 20 on tangible common equity. The results we're seeing in all these big banks are low double digits. They're handling the current environment very well. there is a slowdown underway. There's no question about that. But my view is if you don't get the worst case scenario in terms of what plays out, these stocks have 35, 40% upside in them at some point.
Look at that
We're not there
sell-side
yet.
analyst, Tom Michaud.
No, that's my feeling.
Significant underperformance of everyone else versus one name, JP Morgan. Is that just First Republic? What is that? Where's that outperformance come from?
They've just done a great job of picking up market share.
30
and they've
points worth of good job over Bank of America?
Correct. And look, they have been performing the best. Now, we are not recommending the stock relative to the others that we like because we think the valuation gap is too large. But they've done a good job. But I think the whole industry, by and large, has done a good job. But something Tom said earlier, which I think is right, all banks, though, are not created equal. I personally believe there are three types of banks in America. There are the universal banks, which we're talking about right now. There are the community banks, which are $10 billion and under, which, by the way, are 97% of the industry. Then you've got about 115 mid-cap banks in the nation that are between $10 billion and the top 25. Each one of them has a slightly different flight path to their fundamentals, and after the next couple of days, we're going to start getting the regional banks, which are going to probably have a little more pressure on them from spread income than the bigger banks.
And we saw that with PNC. The spread income is a nice way of saying they have to pay their depositors a lot more than a JP Morgan or a Bank of America does. And so they basically can't capture that delta for record net interest income. How much is this going to render their business model obsolete and really push the division between big and small that much wider?
I think the division between big and small has a chance to grow because all this new regulation that's coming, scale is a way to help you pay for it. I hear throughout the industry, well, we're going to have to cut expenses to pay for a lot of this additional regulation. Meanwhile, you've got non-banks who don't have this regulation who are competing more efficiently. And I like to look at the mortgage market for that one. Not one of the top 5 mortgage originators today is a bank, and non-banks make 60% of the mortgages in America. You would think a home mortgage would be the epicenter of banking. Banks are fully capable of doing it, but they're required to hold too much capital against it, which has pushed them out of the market from a competitive standpoint.
I'm looking at a chart of your Keefe, Bruyette, and Woods index, and I can say we've never been here from 2009. We are solidly out almost 3 standard deviations on a buy of a lifetime. You got a PE off the Bloomberg on BKX of 7.82. I get that it's cheap. I get it's a value. Give me a catalyst. And to me, it's the bank zombie roll-up. When do the mergers happen so you get a payday?
Well, I'll tell you, the industry does need to consolidate. That's a way to make itself healthier, I believe. And typically, you don't see a lot of M&A activity when the economy's on the cusp of a possible recession or when stocks are really volatile. Both those conditions are right now, and I think they will ease. The other aspect is that in the last 2.5 years, the amount of time it takes to get a healthy bank merger approved has doubled. So there's sort of a little bit of a project out of Washington to slow this down, even though I think if you don't do anything, the biggest banks will get bigger faster, and it will actually make the problem worse, in my opinion. What we really need is we need strong mid-sized banks that are able to compete with the big banks, and that won't happen if you don't allow them to buy other banks.
Can you share that number with us again? Not one of the top 5 mortgage originators are banks. Is that what you said?
Yeah. Not one of the top 5 mortgage originators in the United States is a bank. And if you go back about 6 or 7 years ago, 3 of them were.
That's amazing.
And over 60% of the mortgages made in America are made by non-banks. So, and think about why a bank was started. You go back 100 years. It's to help people buy their homes. And they would love to do it. But the mortgage servicing asset, which is where all the value is in a mortgage creation, can't be kept on a balance sheet because the regulators changed the rules. That's why the industry is fighting back so hard on these recent proposals, because they will have consequences and they will push banks out of certain businesses, which will just go outside the regulated
Do you see
world.
the same trends in commercial real estate, or is this just residential?
Well, commercial real estate's already had big non-bank players. And, you know, what's interesting is that everybody agrees. We've done some great research. I've talked to you all about it. We think there's 30% downside in large city, large building valuations. Yet A lot of that's not in the banking industry. Some of it is. I think a big talk of this past week has been Wells Fargo, which put an 11% loan loss reserve on that portfolio, and that's a number. It's gotten all of our attention, but that's not really where the regular regional bank is making a loan. They're not making big loans on downtown. A lot of that is in the insurance industry as well as in the non-banks. That's where the growth has been.
It's good to hear from you.
But I will tell you, there's a...
Gotta go.
Yeah, real quick. So the next couple of quarters are going to be soggy for the industry. I think more than that is priced into the stocks. The stocks are pricing in something worse. If that doesn't happen, that's how you make a lot of money.
Do you want to take it to break as well? You can read the teas if you want. Tom, it's good to see you on the show. KBW, I have got to go. Equities right now on the S&P, negative 0.2%. Bank of America, just a little firmer.
Let's say that rates are between 4.5 to 5.5. And corporate America is not ready for that.
We're slowly moving away from do we need to raise rates another time or not to how long do we need to hold here.
If you look beneath the surface, things are actually, I would argue, pretty good and getting better.
I'm not surprised that we can get a nice rally if we maintain the status quo.
There's evidence of capitulation in the way the term premium moved.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market negative by 0.2% on the S&P. Big hour for earnings on Wall Street. Bank of America just behind us. Goldman Sachs 30 minutes away. The latest from B of A. Trading revenue, a beat. Net interest income, a beat. If you're looking at revenue elsewhere, Tom, better than expected. And if you're looking at provision for credit losses, a little better than expected there as well. That stock is up by 0.75%.
I agree. Everything's sliced dice, pretty optimistic here, and you see it in the price as well. Shonali Basak, not with us today, but she is working, traveling for the company, and it's real simple. She's looking at the bond portfolio, and there is held to maturity, which is, it's not priced right now, mark to market. It's sort of there in the portfolio, and it's a big, ugly number, and that's the stress Mr. Michaud was talking about.
And that story has bullied this stock over the year so far. Year to date, that name is down by something like close to 20%, trying to get up off the mat. The latest from Bank of America and the CEO. This line right here, Bramo, the consumer, the economy, healthy but slowing.
Slowing, although still you're seeing spending coming in above where we were last year, which raises a question, where are we going to? As you really well said earlier this morning, at a certain point, normalizing to what? Where are we going to? How much is this slowdown going to lead to some sort of recession versus just simply a healthy cooling that will help inflation get back down? And these are some of the questions that just are that much less clear this morning.
1, 2, 3, 4 off the mat, the real yield, the 10-year real yield, John, 2.37%. That's a cost of doing capital, doing business, and permeating these bank earnings is a new reality. You know, we do the data check, like you and I go through it, wrote, we're falling asleep. You know what? They got to live it. And they're living a new real yield and an elevated real yield this morning.
Am I sending you to sleep?
No, you're not sending me to sleep.
I hope not.
But you know, we're doing it. We're just reporting the data, and that's fine. These people are living the data, and they're living an inflation-adjusted yield, which is a cost.
The stock is up by about 1%. So we've got Goldman Sachs a little bit later this hour in about 30 minutes' time. Tomorrow, you'll hear from Morgan Stanley. All of that still to come. We need to talk about the latest on the ground in Israel as well. We'll catch up with Oli Krug on the ground in Tel Aviv in about 15 minutes' time. TK, the headline that crossed for all of us in the last 24 hours, the president making the announcement, President Biden traveling to Israel. Tom, tomorrow.
A lot of symbolism here, but I think, you know, within the zeitgeist, if you will, people weighing in. I noticed John Bolton writing in the Telegraph this morning with his perspective, just one perspective, is a president who's playing to the domestic audience. He's going out there and saying, I have relationships, I'm doing this, and the guy I beat 3 years ago, whatever it is, doesn't have these relationships. I think it's it's not only the international moment, John, the military moment, it is also Biden playing to the domestic audience.
And Secretary Blinken needs a helping hand because Secretary Blinken has been so busy in Israel right now. He's been to Jordan, Bahrain, Saudi Arabia, Qatar, UAE, and Egypt. The president traveling to Israel, Bramo, tomorrow, then on to Jordan.
You know, I hope that you're right, Tom. I hope that this is positioning and posturing for the domestic audience. What concerns me, based on all of the things that I've been reading, is a feeling of franticity, of concern that this is sort of the final moments that you can come to some sort of agreement before a wider escalation of the war. This is sort of the tipping point, and that this is a show of force and support of Israel to try to deter that type of action. And that's been some of the analyses that I've been reading.
John, you can take it domestically on the triangulation we've been talking about for 4, 5, 6 days of the Gaza Strip up to the West Bank to the east and then up north. And certainly Hezbollah and the Lebanon border is front and center this morning as a thing away from Gaza. But then you expand it out from there, and that's where this diplomacy is almost a separate discussion from what we're seeing in the Gaza Strip.
Intense diplomacy over the last few days. I'll try and make it simple. There's really nothing simple about this. I think there are two objectives for the president in the next 24, 48 hours. One, to prevent the conflict from engulfing the whole region. And two, to try and help develop a plan to get aid into Gaza, which is far more complex, Lisa, than meets the eye.
Especially given all of the potential concerns on the Israeli side about checking some of the trucks going in, on the Egyptian side in terms of their liability and potentially people coming into their nation. And then, of course, the mystery of how much Hamas is really being an obstacle to some of the aid coming in.
Let's turn to the price action just to get you all up to speed if you are just joining us. On the equity market, on the S&P, we're negative here by 0.25%. Yields a little bit higher on a 10-year here, Lisa, up 5 or 6 basis points, 476.26.
Healthy but slowing economy, healthy but slowing spending. We get the latest 8:30 a.m. in about an hour and a half. U.S. retail sales for the month of September. Just how much can U.S. Consumers keep spending? Today, Fed speak includes New York Fed's John Williams, Federal Reserve Governor Michelle Bowman, Richmond Fed President Tom Barkett, and Minneapolis Fed President Neil Kashkari, talking about all of the unknown unknowns, and somehow this will be interpreted as some sort of guidance and forward guidance at that. And today, we did get the Bank of America earnings in about 25 minutes. Goldman Sachs, United Airlines after the bell, setting up a big week where we start to get some of the tech earnings as well, John.
And I've told David Weston catching up with Brian Moynihan a little bit later on this afternoon. So we'll carry that on Bloomberg TV and Radio. Do not miss that conversation. David Weston with the Bank of America Chief Executive in a few hours' time. Joining us now, Michael O'Rourke, Chief Market Strategist at Jones Trading. Michael, let's start with the financials. Bank of America behind us, JP Morgan, Wells, heard from all of those. We'll hear from Goldman later. What gets some of these banks out of the penalty box? What is it? What do we need to see?
You know what? I think the market people need to look somewhere else and look somewhere different. I think the interview you guys did with Thomas Show right now was excellent. I thought he brought up some great points that this group is just not loved. And it's out of favor, but it's attractive from a valuation basis, and just a little bit of good news will get things going in the right direction.
Michael, I look at what to do here. What do you do with cash? Don't give me dollar cost averaging. Everybody's too nervous right now. But if I'm in cash, how do I deploy, or do I sit tight?
I like the bond market here. I think the Treasury sell-off is a real move, but when you look at those 2-year yields, they're very attractive in the 5% range. But even if this Treasury, this 10-year Treasury sell-off continues, which I expect it will for a little bit, go a little further, they're starting to get attractive, and that's the problem for the equity market right now. Is if you have a 10-year yielding 5%. That's on par with the S&P 500 earnings yield, which, again, should have a risk premium tied to it. So I think that's the dance that's going on in the market. I think that's going to continue into year end. And I think I'd start allocating towards those bonds at this point in time.
In the earnings season here, one of the great mysteries to me is the top line revenue. I sound like Tom Gelvin years ago at DLJ. Michael O'Rourke, if you look at the nominal GDP linkage over to revenue, do we underestimate the glow of this earnings season?
Well, yeah, I think the problem in this environment, when you're looking at the top line numbers, is it's an inflation environment. Prices are going up. Prior to this environment, the past 2 decades, that was a good gauge of strength for the company, strength of the economy. The problem today is you have margins getting squeezed on the bottom line. So while yes, prices everywhere are rising, we're all well aware of that. It's hard to interpret that as true economic strength because the companies are likely feeling their cost pressures pushing up on them as well.
So, Michael, what I'm hearing from you is that earnings might not be the compass to prevent this from being a perpetual kangaroo market, as Jonathan Stubbs put it earlier this morning. It's not necessarily going to be some of the economic data unless we get something that's really decisive. So what do you see as providing some sort of compass through a pretty unclear time?
Well, I think what happened, we had that FOMC meeting last month where I think the Fed really sent the message home that we are going to be higher for longer, and you start to see the market react. Since that meeting, all the major indices have traded off. The Russell 2000 probably the most. I think it's down about 3.5%. S&P 400 down 2.5%. What was interesting to me is when you take out the Magnificent Seven names, the S&P 500 also, the other 493 names, dropped 3.5%, even as much on par with the Russell. So you're seeing that weakness emerge throughout the broad tape that I think the market's in a process of pricing in. I do think the events last week create some uncertainty, geopolitical uncertainty that created some noise in the trend that was developing. But I think you're seeing it this week. That trend's reasserting itself. You're seeing Treasury bonds sell off. You're seeing yields rise. I expect the pressure to reemerge in equities here.
How much do you think that this could persist, even if we get better than expected earnings, as long as Treasuries stay where they are?
Well, there was a great story in the Bloomberg terminal yesterday about the big five tech earnings, talking about how they're supposed to grow earnings 34% year over year this year, right? And that makes sense. That group of names is up over 50% this year, though. So that's really priced in. But it shows those names drive so much of earnings. And they say, I guess the rest of the S&P 500 will be down 5% earnings-wise. So I think that's what people are clinging to, those big names. But what's interesting is the second best earnings growth is expected to be from the financials, up 31%, except that group's down year to date. And I think we need to see investors start shifting their focus outside a handful of names, because those are great companies. If you want to invest in those companies. But there's many other opportunities in this market that people should be looking for, but we're just not there yet. Everyone's still passively betting on the index, and I think that means this has time to play out.
Michael O'Rourke at Jones Trading. Michael, thanks for your input, your insight, perspective this morning. Appreciate it, buddy. Missing Sonali Basak this morning, sent across an email. I think this is really, really important. Whenever you frame what they're saying about the consumer at these banks, you need to think about which consumer. So when you hear from Brian Moynihan and they say the consumer's healthy, things are slowing, but the consumer's healthy, this is the consumer they're talking about. And thanks, Sonali, for passing along this slide. Consumer credit cards, new accounts, average credit score, 774. 774. That is like ridiculously high.
And that's what we've been hearing. All of the big banks have been upgrading who they serve. This is banking for the wealthy, banking for the well credit score yield. And this just increases the divergence, again, with the big banks and the small banks that might not have that kind of discretion.
But where Thomas Schode I thought was brilliant with his decades of experience, where are the new 4, 5, 10 banks beneath the majors that are going to actually compete? And the answer is that's a conundrum the government faces, the people face, with all of the legacy back to the 19th century.
If you are just joining us, welcome to the programme. Bank of America here by 0.6% in the pre-market. Your equity market negative by 0.3%. If you look across a range of businesses, consumer vehicle lending, we're pushing 800 on the average credit score. And it's been climbing quarter to quarter, from 789 in the first quarter to the second quarter. Tom, it's amazing to see.
I don't have the statistic in my head. Did you see the delinquencies on auto loans of younger people? I'd never seen that number in all my history.
They don't have credit scores that look like that.
They don't have credit scores like that.
Just let me go through them, Tom. Third quarter 2022, 789. Second quarter 2023, 795. And now third quarter 23, that number's climbed to 796. We're getting closer and closer to 800. For anyone who tracks their credit score, 800 is high. Really high. Really. That's like perfect credit history.
Yeah, that bill has that. I don't have it.
Fantastic.
Yeah. Lisa, the bond market's walking away. 6 basis points. I mean, we're walking away in the last hour or so. What has the spread market done the last couple of days in all this?
It's been calm because of exactly the sort of financial, and I don't say this to be pejorative, financial engineering that companies have done to push out maturities. But John, to your point about this question about how removed big banks are with their guidance and with their balance sheets from the larger trends in the economy is really going to be a question if they're really focusing only on pristine credit it, and individuals who have that.
Thomas Show, KBW, big takeaway from that whole conversation. That number he gave us, out of the 5 top mortgage originators in this country, none of them are the big banks anymore.
It's all non-banking institutions that can afford to do it. They have to hold so much capital. Maybe that's why they want people with perfect scores.
TK, you're banking at B of A?
Well, I don't have banks, actually. I have no money.
I thought you were going to say I don't have a good credit score.
But, John, the bond market's walking away. I got a 238 on the real 10-year yield with Goldman Sachs coming up.
6 basis points higher, 476. Goldman Sachs later this hour.
Thursday, the Economic Club of New York hosts a conversation between Fed Chair Jay Powell and Bloomberg Wall Street Week's David Weston. Recession risk, inflation outlook, real estate amid high rates, and more. The live interview happens October 19th at 12 p.m. Eastern on Bloomberg. Context changes everything.
On Wednesday, President Biden will visit Israel. He's coming here at a critical moment for Israel, for the region, and for the world. First, the president will reaffirm the United States' solidarity with Israel and our ironclad commitment to its security. Second, President Biden will underscore our crystal clear message to any actor, state or non-state, trying to take advantage of this crisis to attack Israel. Don't.
That's the message from Secretary Blinken, U.S. Secretary of State, speaking in Tel Aviv following a week of intense diplomacy. The announcement in the last 24 hours from the president reading as follows. On Wednesday, I'll travel to Israel to stand in solidarity in the face of Hamas's brutal terrorist attack. I'll then travel to Jordan to address dire humanitarian needs, meet with leaders, and Tom made clear that Hamas does not stand for Palestinians' right to self-determination.
It's going to be fascinating to see how he messages it. Does he speak in Israel? How does he approach it with not only Mr. Netanyahu, but with the political debate within Israel? I'm just fascinated to see what the body language is. I have no clue.
And Tom, how difficult it will be to develop a plan to get aid into Gaza, given what's happening at the southern border.
Well, yeah, that's the heart of the matter. I mean, Lisa, help me here. I'm not up to speed on this. Is the southern border of Gaza open at this time into Egypt?
The reports seem to suggest that no, it is not.
The answer is no.
Right.
It is still not. That conduit out the southern border in Egypt is not there. Right now, let us go to Tel Aviv, where our Oliver Crook reports. Oliver, how will the President of the United States be greeted tomorrow in Tel Aviv and in Israel?
He will be greeted very happily by the officials here and by the people here in Israel. And really it comes as, all of the officials here that have arrived have had the same sort of message, which is unflinching support for Israel. And we expect the same from President Biden. And that is unflinching support politically, militarily, and also possibly financially. We have some reports out from the New York Times that Israel has asked for $10 billion in emergency aid. So that will be in focus. But so too will deterrence and diplomacy. The naval carriers groups that are heading to the East Mediterranean, but also the diplomacy side when he goes to Jordan later tomorrow to meet with the president of Egypt, to meet with the president of the Palestinian Authority and the king of Jordan. This will all be front and center. And really the focus there is going to be aid, getting aid into Gaza.
Ollie, we've talked about the uncomfortable tension hanging over the Middle East for much of the past 3-4 days, seemingly on the brink of a full ground invasion. Based on your reporting, Ollie, the people you're speaking to, are we still on the brink of a full ground invasion?
Yeah, I think that we're on the brink of a ground operation. The question is, what form will that take? And this is sort of an important point to make. I think a lot of people are expecting a full-on tanks rolling in, scorched earth sort of approach. We've got sources and we've got some conversations with the IDF earlier this morning who said that basically you need to throw out everything you know about how they've operated in the past in Gaza. This could be a very different approach than what they have done in the past. This could be more sort of precise. This could be smaller operations. And as the defense minister warned last night, this could go on for a very long time. And this in part with the concern of what happens if they do succeed in dismantling Hamas. What comes next? This is a very sort of open question here. And again, the question of a second front is also looming large over this whole conversation with more skirmishes on the north with Lebanon.
Ollie, thank you, sir. Stay safe. Bloomberg's Ollie Crook in Tel Aviv. To Ollie's point, Tom, two objectives here for the president. They're worth going over repeatedly. One, he's got to try and prevent this conflict from being a whole lot more broader than it could be.
Yes,
and two,
no question.
to help develop this plan to get aid into Gaza. is easy to talk about. It's tremendously difficult to execute. Right. Clearly, the Israelis are worried about not just aid coming across the border, but also munitions as well. And that's the issue.
Yeah, with historical perspective on this, Henrietta Trays with Veda Partners here on how Washington will respond. Henrietta, to John Ferro's point there, it is about aid. Let us go back to 1973. Nixon and Kissinger, and basically they did an airlift to Israel. Does Congress want to support President Biden if an airlift is required to support Israel?
I think they do. I think they're very eager to start taking votes on all kinds of aid, whether that is munitions, extra enforcement of the Iron Dome, anything that the president needs on a military basis. And then there's also a strong desire to provide financial aid. We just heard from your great reporter in Tel Aviv that they're looking for $10 billion on the Israel front. Right. I would not be surprised if when that gets over to Capitol Hill, they try to increase that dollar figure. That's usually what happens as members seek to sort of illustrate their support for the nation.
Henrietta, you are expert on the body language of Capitol Hill. I think of John Huntsman Jr., former governor of Utah. His family has pulled money in the last 24 hours or stopped donations to the University of Pennsylvania over some of the debate and protest there. How are the Congress people that we have, how are they reading the mood of America on this war?
You know, that's a great question. I think the fallout is only beginning there. As right now, we're sort of in the immediate aftermath where there's reticence to come out in opposition to anything that Israel might need right now. But as we get into the days and weeks ahead, I think to echo some of the commentary we heard from former President Bush, there's going to be a loss of interest in this, which I think is very real and borne out by historical realities. And what happens is you start to get factions. Already there are a number of bills targeted at penalizing in some way the Biden administration for the $6 billion from Iran. That's only going to get exacerbated. So I think people are really reticent to voice their fulsome views on where things are with either Gaza and Palestinians, Hamas, or the Israelis, and that will probably foment in the days ahead and get more aggressive.
Unlike Ukraine, do you expect that opposition to come from within his own party, within the president's own party?
I think it's going to come from a whole bunch of different outlets. You have a pretty far right, extreme sort of anti-Semitic component, and then you also have a very far left pro-Palestinian component. And both of those are just going to get louder in the days ahead. And especially as the ground invasion starts, there's a lot of attention on that right now. Obviously, Secretary of State Blinken is heavily focused on containment and making sure this does not escalate. The Biden administration's moved 2 aircraft carriers into the arena right now to try to make sure that that doesn't happen. But that escalation is something to really be mindful of. And I think the extreme positions exist across the political spectrum.
There is also talk about American troops here, Henrietta. I shared this story with our audience in the previous hour. I'll do it again for people just joining us from the Wall Street Journal. According to US defense officials, that the US military has selected roughly 2,000 troops to prepare for a potential deployment, support Israel. The troops are tasked with missions like advising and medical support. Important to point out what they're not there for. They aren't intended to serve in a combat role. No inventory have been put on prepare to deploy order. And this as well, it isn't clear under the circumstances the US would actually deploy the troops or to where. Henrietta, talk to me about support for that in Washington currently.
I don't think support for troop deployment is there, just as we saw with Ukraine. The most fascinating stories come from the sort of personal anecdotes of Americans going over to Israel to sort of volunteer. But I don't think troop deployment is something that this administration is prepared for. As I mentioned before, I think their effort is to contain and prevent escalation that might ultimately require something like troop deployment. We're happy to throw money at the problem. I think there are more than enough votes for that. And indeed, what I've been telling clients is not only are there votes for the funding, but the funding is so popular that it can carry other things like aid to Ukraine, aid to the U.S.-Mexico border, and probably a government shutdown avoiding position. But I don't think troop deployment is something that any member would voluntarily talk to you about right now.
Just quickly, speaking of votes, got to squeeze this in about 20 seconds if we can. Will we have a speaker by the end of the week?
I have no reason to update my priors, to be honest. I mean, they don't have a bill requesting aid to Israel. They don't need a government funding bill until November 17th. I fail to see the urgency.
Henry, thank you. Henrietta Trays there, Aveda Partners on the latest. Goldman Sachs just dropping across the Bloomberg. I'll break the numbers. We'll come back to it in just a moment. Third quarter net revenue, $11.82 billion. The estimate, $11.13. Big number for Goldman. Fixed sales and trading revenue, $3.88 billion. The estimate, $2.86. That, on first look, is a big upside surprise for that specific metric. That stock is just about unchanged. Much more on the numbers from Goldman Sachs up next. From New York City, this is Bloomberg. Coming off the back of a decent day of gains on the S&P 500, equity futures look like this. On the S&P, on the Nasdaq, we're negative by 0.3% on the S&P. On the Nasdaq, down by about 1/3%. And much more on the bank earnings in just a moment. In the bond market, yields all over the place over the last few months. Your 10-year this morning higher by 6 basis points, 4.7647. Your 30-year having a little look again at 5%, up by 6 or 7 basis points on the session to 4.9169. At the front end of the curve, it's been pinned but creeping higher over the last couple of days, up a single basis point, 5.1135, 5.1156. Worth pointing out, in about an hour from now, US retail sales just around the corner. Looking at foreign exchange, we look like this. The euro against the dollar shaping up as follows. The euro 105.72, positive on that currency pair by 0.1%. And to round things out with the financials, Bank of America earlier on today with a series of little beats. That stock is up by about 1%. It is down hard on the year. Year to date, it's down by almost 20% coming into the session today. For Goldman, positive by just 0.1%. Under surveillance this morning, Goldman reporting better than estimated third quarter results today off the back of what we heard from Bank of America a little bit earlier. Goldman, the fifth of the big 6 US banks to report better than expected earnings. Tomorrow, we'll hear from Morgan Stanley. The numbers read like this. For net revenue, $11.82 billion. The estimate, $11.13. Lisa, fixed sales and trading revenue, big number for Goldman Sachs. Big beat, $3.38 billion. The estimate, $2.86.
They also beat in equities, which is notable considering that JP Morgan did not, and we saw something similar from Citigroup. So there's a real question here about how much they're fortifying the core of their business after coming under a lot of fire for their consumer-facing business. So really, does it seem like they're leaning back toward the core of investment banking and maybe away from some of the other interest-bearing peripheral businesses?
To your point, Lisa, equity sales and trading revenue, $2.96 billion. The estimate, 2.68. Some commentary from David Solomon, the Goldman Sachs boss. Tom sees a continued recovery in capital markets.
Oh, that's what it is. He's going to lead with that lead story here. I look at the book value differential with Morgan Stanley, and it's an absolute train wreck. They're under 8% return on equity. They've got a 3/4 single-digit return on equity, John, that goes back to COVID. I went to the Marcus website. It says, keep the growing going. When did they jettison Marcus?
Stock is down by about 0.1%. It's your go-to question on this name every single quarter. I'm with you. I'm with you.
Allison's here to calm me down. She'll medicate me.
Allison's going to calm Tom down in just a moment. Allison Williams, that conversation, a few seconds away. Elsewhere, President Biden traveling to Israel tomorrow, planning to meet with Prime Minister Benjamin Netanyahu ahead of a looming ground strike in Gaza. Israel saying it's keeping open a safe corridor for people to evacuate the northern Gaza Strip. More than 600,000 people, Lisa, have already left for the south.
And humanitarian organizations are saying that really there's only just hours left before there's a full-blown crisis and there needs to be water and food delivered. How much of the President Biden visit is really devoted to that, to ameliorating some of the burdens on the Gaza individuals, the Gaza residents who are leaving, who are displaced, while also supporting Israel? It is a delicate needle to thread at a time where, honestly, the entire region is like a powder keg of emotion, and you're seeing that percolate through the rest of the world.
It's a two-part story through the next 24 hours or so. We've talked a lot about the visit to Israel. Tom, also need to talk about the visit to Jordan. There's going to be a meeting there with the Egyptian President al-Sisi, Palestinian Authority President Abbas as well. So it's going to be a busy couple of days for the president.
I think you're totally correct to focus on also our dialogue with the adjacent Arab nations. It's underplayed right now. It's underplayed in the zeitgeist this morning, and you're 100% on it. And I really want to emphasize here, Egypt is, from every report I got in Morocco, beleaguered beyond beleaguered, and they need money. That's what this is about.
Let's wrap things up with the dysfunction in Washington, D.C. Congressman Jim Jordan of Ohio looking to become the next Speaker of the House with a vote at noon today. Jordan emerging as a front runner after Majority Leader Scalise withdrew his bid in the last week. Jordan is expected to move forward with today's vote despite holdouts in his own party. The margins are razor thin. He can lose no more than 4 votes against United Democrats. Tom, you said in the previous hour, we're talking about really, really small margins to try and make this happen.
Well, and again, I said it was 4% with McCarthy, and it's an even more narrow margin for the gentleman from Ohio. He had a pretty good Monday. If he has a pretty good Tuesday, that's 48 hours of joy.
Well, I'll take that point. Pretty good Monday means that he got a lot of never Jordans to come on his bandwagon. There's a question about the fact that he is considered an election denier. He's considered a Trump supporter. He's considered someone who is part of the Freedom Caucus, and he is getting some of the moderate Republicans on board because he's trying to say, let's get it together, and we need to coalesce around something, because otherwise, what if we have a moderate, Democrat to be the representative, right? I mean, that alternative, that's why I say peer pressure. It's sort of, that's the reason why you start to see some of the Republican caucus members coming along.
If this gets done, Bremo, do the odds of a shutdown go up? Is this a reason to buy the long end of the bond market?
It's a great question. If I knew the answer, I would probably be in a different place. I think that it's a great point, because how likely is it that Jim Jordan is going to come to some consensus with Hakeem Jeffries and the Democrats on the other side of the table, considering just how divergent some of his views have been from even the moderates within his own party?
We've got to monitor a series of ever-evolving probabilities around certain stories. You would imagine the odds of a deal between the two go down and the odds of a shutdown go up, and maybe that puts the brakes on growth into the end of the year.
This might be the reason why I focus on bond yields, because that's a simpler mathematical calculation than the odds of all of these things. And then the market reaction to it, which just seems like a lost cause, which is why I think a lot of people aren't even paying attention.
For what it's worth, I'm not sure what bonds tally right now, because bonds are nuts. We're up by 7 basis points on a 30-year, 492. Just to return back to Goldman, Tom, it's a beat on revenue, it's a beat on fixed sales and trading revenue. The stock, if you're looking at Goldman this morning, TK, unmoved by this. We're negative by what? 0.9%.
Unmoved by this also is the board of directors of Goldman. This is going to be an interesting 90 days. Allison Williams joins us with decades of perspective here on the parlor game. The BQ screen, Allison, tells me that Fortress Solomon is trading 31% below book value on Morgan Stanley. They're getting their clock cleaned on a market valuation. When do they jettison Marcus? I get the talk, I get the zeitgeist, green sky. I don't care who's to blame. When does the board say, lose this loser because Marcus is keeping the growing going baloney?
Yeah, I mean, they're close to done, right? So they announced green sky. They're taking a hit this quarter. Lisa, we were discussing some of the reserve impact. There was a relatively big reserve release. There was a relatively big charge off there. They've announced a sale of United Capital, right? They decided they do want to go after that mass market, but they don't need to own it.
Oh, come on. Who do they sell Marcus to? Who do they sell this dog to?
And the Marcus loans have largely been sold. So it's really just the deposits that they're focusing.
But it's an image thing as well. If I'm on the board of Goldman Sachs, I'm saying, this is all great. Thank you for the comments on banking, David Solomon. This is not good for the company. In the chart, for those of you on radio, we've got a year-to-date chart. It ain't pretty. When do they jettison that so they can say it's behind them?
I think the pressure from investors is really more on the cost side and how they can meet their overall cost goals. I think the consumer business, as you said, it's a lot of headlines because it's very unlike Goldman, and it was sort of a little bit of a head scratcher when they went into the business. It was almost like a negative foreshadowing for the rest of their business that they would do that. But I would say that investors never owned Goldman Sachs to own that, and I think investors are probably happy that they're focusing on they're focusing on their core, and their core. I mean, the trading results. Very good, but investors likely anticipated that, and that's why you're seeing the stock flat.
I think it's telling that the Financial Times had a story about David Solomon's DJing habits and the potential for him to withdraw from some of the high-profile DJ events that he has been doing. It highlights how much of a distraction this has become. How much is this part of what's been baked into some of the disappointing performance of the Goldman Sachs shares?
So I think, there's definitely the headline aspects, and then there's the core operations. And I think the shares, it's been a tough year for them. They've had a lot of messiness in the numbers, and I think the shares are reacting more towards that. Investors want to know how are you going to get to your targets? And it's not a clear path right now. One thing I would say about Salomon that he has done versus prior managers is he put out targets. Goldman never did that in the past. They didn't have investor days. They didn't put out targets. And the increased transparency has been a little tough for them on that front. I think to your point, regarding the DJ, regarding a lot of the negative press, Goldman most likely wants to get away from that and really just focus, again, back to the institutional audience, the institutional customer, and their institutional reputation.
And that's really what we've been hearing, that he's actually done a pretty good job and that some of the animosity comes from another place. There is a question, though, about why the shares are not responding better, particularly to the outperformance in equities, considering the fact that they outperformed even though JP Morgan and Citigroup did not.
They didn't. And I think it again comes back to the overall profitability. We want market share gains, but we also want profitability. And when you talk about a price to tangible book multiple, that is really going to depend on the path to profitability. And I think getting past a lot of this noise and cleaning that up. And I guess the other thing I would say, because another thing in the media, there's a lot of talk about employees and partners. If bankers don't want their pay to go down. Shareholders do want the pay to go down. So it is, there is a give and take in terms of who you're making happy as management. And when it's a tough year and it's not due to the core business, bankers are going to be even more unhappy.
Okay, but this is important. Let's say they got a run rate of 8% return on equity. If you take out these train wrecks, let's say they one-off them, you take out the one-offedness of 2023, what's your plug-in for return on equity for Goldman Sachs right now, X the tragedies?
Well, I'll have to go through the results to see what it is today, but if you look at their core business and some of the things they're doing, they should be able to get to that mid-double-digit type return.
Get back to 13, 14, 15%?
I think.
Like do a double.
So we talk a lot about their consumer business because that's, has not worked out. But two things that have worked. The transaction banking business, I thought that was a great idea for them. It seems a natural fit, and they've actually done very well. That's a business that they're keeping. And the alternative strategy, where they're basically leveraging, their expertise, but not investing their own capital
Who do they
anymore.
sell the rest of this to? I don't understand who they sell Marcus to. I get silence on this from everyone.
Well, the Marcus, a lot of their loans are sold, the ones they don't want to be in. That's
okay,
sold
they've
down.
done that. That's smart.
And so what's remaining is very tiny. It's really more the deposit side of things. It's really
tiny,
more
but
just,
it's
more the deposit side of things. And just so the final point just on returns, their alternative business, as they move that off balance sheet, that's really going to be core to them improving their returns over time. So we talked a little bit about Morgan Stanley. They've made the shift to asset and wealth management, high ROE business. It's the clients that have the assets. Goldman is moving more towards that model. As they do that, their returns should follow.
Alison, thank you. Alison Williams of Bloomberg Intelligence. The latest there on Goldman. That stock is down by 0.1%. Earlier on this morning, a beat from Bank of America. Tune in, 2:15 Eastern Time. David Weston interview with Bank of America CEO Brian Moynihan. That coming up a little bit later on this afternoon, 2:15 Eastern Time. If you are just joining us, welcome to the program. The S&P 500 negative here by 0.26%. Yields a little bit higher by 5 or 6 basis points. The 10-year, 476.26. If we're going to talk about David Solomon's DJing, got to share this comment from the spokesman over at Goldman Sachs. Reads as follows. This is not news. This is to the FT, not to me personally. David hasn't been publicly DJing at an event in well over a year, which we have confirmed multiple times in the past. Music was not a distraction from David's work. These lines are always my favourite. The media attention became a distraction.
The John Ferro attention.
The media,
I barely talk
about it. I hardly talk.
It's Bramo's fault.
I couldn't care less. I honestly couldn't care less. To Alison's point, clearly, internally, there was some upset there about how much they were being paid. Externally, if you're an investor, I imagine, Bramo, you're not sharing those same concerns.
Maybe it's a good thing. And that was sort of the implication, in the sense that if you have really highly paid partners and they leave and they're people who are competent coming in, and that's an if, well, aren't you getting your expenses down? Isn't that a good thing?
Is this a media distraction?
I don't know. I mean, honestly, I think that there's a lot of sour grapes. Clearly, there are a lot of just personal tensions here that are also coming to the fore.
That's correct.
I'll leave it there.
We're all in agreement. That's nice. Next hour,
Once a year.
8:30 Eastern Time. Greg Dacko, Chief Economist at EY, following US retail sales data. That retail sales data just around the corner. And we've almost wrapped up the big banks on Wall Street. Morgan Stanley still to come. That's coming tomorrow. From New York, good morning.
You might get ready for the fact that a lot of these firms may not make it with the higher rates, which again feeds back into my view that this is why we should hold rates steady. We should not at this point be thinking about any increases.
That was Philadelphia Fed President Patrick Harker speaking at a virtual event. This conversation really started in Jackson Hole, Wyoming, around the table with us in Jackson Hole on Bloomberg Surveillance, when he indicated that companies in his district, his region, Lisa, were indicating to him that we've seen enough. We're facing a little bit of pain. Pain that he was seeing in his constituents that he was not seeing in the headline data, and given him reason potentially, alongside others, Bramo, to pause.
And he talked about how anecdotal evidence has actually been more of a leading indicator than some of the hard data that everyone looks at, and that these anecdotes that he was hearing from his constituents were a better tell on what was going to happen. If that's the case, how much does that explain the reluctance of some members of the Federal Reserve to go further, to really talk about really elevating rates that much higher, even as they talk about holding them for a very long time?
This is why the beige book is so important.
Exactly. I was actually thinking that. That's why I'm going to read it, the whole thing.
Is that the pitch?
Yes.
All right. You can give Tom the summary.
Come on. You
I'm
told
with
me
you.
you're going to read it. You read it too.
Of course I will. All
Thank
right.
you.
Don't out me. Come on. Trying to stay cool here, Bramo.
Oh, yeah, you're doing a great job.
I don't read.
All right.
Tons of Fed speak. Williams, Berman, Barkin, Kashkari all talking today. Megan Draper of Barclays weighing in on the Fed's path forward, saying this: we maintain our call that the FOMC will hike 25 basis points before year-end, though not necessarily in November. Although higher long-term yields have put a lid on market hike expectations for now, we expect another round of resilient incoming data next week to shine a bright spotlight on Powell's pre-blackout speech. That pre-blackout speech coming on Thursday, a conversation with Bloomberg's David Westin and the chairman of the Federal Reserve, Jay Powell, at the Economic Club in New York. That is one to watch, Tom, ahead of the quiet period.
It's one to watch it. I'll go with that. And as I look at this meeting and I look at the few other meetings here, let me get the surveillance calendar. It's available on the Bloomberg Professional Service, John. You can go in and go November 1, and you can Wall Street. Remember the December meeting was dead? Says who? December 13th? You think so? I think it'll be an interesting story with more economic data. Megan Draper joins us now, global co-head of debt capital markets at Barclays. Megan, you note the disinversion out there, the yield curve's doing what a yield curve should do. You suggest that extends the timeline for the Fed. How does disinversion change the Fed's timeline into 2024?
Yeah, I mean, I think it's fair to say we've entered a far more complicated phase of this cycle. The market's really now in a daily tug of war with policymakers around the path of rates. And I think there's been a lot of misinterpreted signals this month. I think the real question in my mind is what Powell and other members of the Fed opt to message this week ahead of blackouts in the context of what continues to be a rapidly evolving backdrop. But you've got a strong dose of reality for the market between employment data, CPI, right, PPI, UMISH. I mean, all of that combined, I think, plays into how markets are responding, particularly on the rate side. But I think we've read far too much into recent Fed speak that implied that these higher rates might have actually done some of the heavy lifting. And what I think the market has failed to take into account is the nuance behind the why. I mean, why are financial conditions tighter? If it's the strength of the economy, which is fueling these longer term interest rates, they may actually need to do more. And I think if you dug into Logan's commentary, he suggested as much.
In your head, what is the level of the 10-year yield where Powell and company are overcome by events? Is it a 5 handle or is it something more subtle than that?
I'm not sure they're really focused on a nominal yield as being the determining factor. I think it's more about financial conditions, tightening of financial conditions, and buying themselves room to continue to evaluate the data.
How much, Megan, do you see a potential risk to credit as yields go higher and potentially the Fed does more, which, as you think, is your base case?
Yeah, I mean, I don't think we can underestimate how hard it is for risk assets to rally meaningfully here when treasuries are this volatile. And yet we are, with everything going on, seeing a very resilient credit market. I mean, 3-month spread balls at the lowest level since the start of 2022. Spreads on the corporate index are still hovering near the tights at 124. So it's been a strikingly tame backdrop in the face of this elevated rate vol and even with some of the geopolitical overhang. I think as you talk to investors, what we're starting to see is a bit more polarization in terms of how accounts are approaching the market. So there's definitively more discipline being incorporated in terms of investment decisions. If you're total return focused, I think you're waiting for the dust to settle a bit on some of this intraday volatility. If you're yield focused, there's a very attractive entry point here that we continue to see for insurance and pension money in particular.
That's from the investor side, Megan. One reason why it's wonderful to speak with you is because you also speak with the corporate finance officers, and you understand the angst of paying more than 10% yields, at least if you take a look at some of the market rates for about a third of the high yield index. How much angst do you feel among corporate executives as they look out at their runway and wonder when they're going to have to actually face off with these higher interest payments?
In investment grade, there's a decent amount of complacency talking to both Treasury teams and CFOs as they think about evaluating markets here, in part because there's very functional market activity as and when they do need to come to market. So there's a degree of patience I think we're seeing. We are seeing a backlog build for this post-earnings window, but October has been the quietest start to a month. Going back to April, so when we were dealing with the regional bank volatility. So there's a willingness with very manageable maturity towers for issuers to sit this phase out. I think you're likely to see deal sizes smaller and shorter as a result.
Bringing your debt world over to economics, where is your real yield out 6 months, out a year? We've got a 235 level, 10-year inflation-adjusted yield. Where do you see that out a year, say?
Out a year. I think we're going to be range bound for an extended period of time here. We don't see cuts playing into the equation until at least past September of next year. So a year out, maybe we're seeing some reduction from current levels, but I think we've got a ways to go before we see that play out.
Are we learning, Megan, that this is a corporate and consumer structure in the U.S. economy that can handle 5% rates for a longer period of time, or have the lags just gotten much, much longer?
In investment grade, I think things are reasonably well insulated. You only have 7% of maturities coming due over the next 12 months, and it's closer to 17. Where we've got greater concerns is probably on the high yield side, where those maturity towers are definitively looming. So looking at both bonds and loans. So I think it's going to be have and have nots as we look at the path ahead.
Hey, Megan, thanks for being with us. Megan Draper there of Barclays on the latest with the Fed speak. So much Fed speak this week. Just a ton of Federal Reserve officials with scheduled speeches right the way through to the quiet period, which begins this weekend. Interesting interpretation of the Fed speak we've had over the last few weeks. Context matters here. We were having a massive bond market sell-off. We all had one question. Was the Fed going to tolerate this or imply that sell-off would do some of the work for them? Then they started to come out. Mary Daly with Lisa of the San Francisco Fed, suggesting that maybe they can outsource monetary policy to the long end and allow the long end of the bond market to do some of the work for them. Now, I refuse to believe that is not the way they knew that message would be perceived. I refuse to believe that. They must have known that we would sit here, hear those comments and believe that they're outsourcing monetary policy to the long end, that the sell-off is doing some of the heavy lifting for them. If that's not how they wanted that message received, look at all these speakers today. Williams, Bowman, Barkin, Kashgari. Tomorrow, Waller, Williams, Bowman, Barkin, Harker, Cook.
You're good at this.
Powell, Jefferson, Barr, Goolsby, Bostic, Harker, Logan, Thursday.
Harker,
Mester, Friday. It's a song. It's beautiful, isn't it?
Gifted.
Okay. That's the opportunity to correct course. They know what we all think. They know what most people think, not me personally. They get the chance to correct it if they want to, Bramo. And if they don't, then message received, it was the right message to receive.
Although it's unclear whether the market moved on that message, right? It's unclear how much the move lower in yields and higher in price that we saw last week was due to this or earlier this week, or just due to some other issues. To me, the issue that Megan said that I think is very important is the why. Why are yields going higher on the long end? And if this is because of greater economic momentum, then maybe that means the Fed has to do more on the front end, which is what she believes later this year.
Clearly at IMF it was a debt panic, just the sheer amount of debt and future issuance of debt as well. I just did a careful mass study of 30-year gilt in the U.S. 30-year, John, and frankly, there's more convexity. It's better behaved in the United States towards higher yields. And I still say nobody's really modeling, and we mentioned it with Allison on the banks. Are people really modeling out higher interest rates, or is it just like, as Megan said, it's just where we are and things will get better? I don't buy it for a minute.
We've got high yields this morning, up 6 basis points. Your 30-year, 4.91.35. Yeah. Coming up on the market, Bob Dole of Crossmark Global Investments. In the next hour, the attention turns to the economic data. U.S. retail sales just around the corner. The last big data point before Chairman Powell speaks to Bloomberg's David Weston on Thursday. To round out the bank earnings, we've had Goldman this morning. We've had Bank of America. Tomorrow, Morgan Stanley. From New York City, this is Bloomberg.
This whole year has been a year of a market that's been on its toes and on edge.
There's a lot of checks against the market at this point. That doesn't necessarily mean the market has to retest last year's lows.
If we get this geopolitical escalation, I think the back end is going to start pricing in a true flight to safety trade.
It's the back end that's where the action is. And I think there's a lot more safety in the front end right now.
I think we've gotten a lot of good inflation news in the last few months, but we're not there yet.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Bloomberg Surveillance. John Ferro, Lisa Abramowicz, and Tom Keene, thank you for being with us with bank earnings, perhaps secondary to what we see in Israel. The President of the United States will travel to Israel. John, that just supersedes all that we talk about in economics, finance, investment.
Without a doubt, Tom, before heading to Jordan to meet with Arab leaders as well, we've talked about this uncomfortable tension hanging over the Middle East for the best part of a week now, TK, still seemingly on the brink of some kind of ground invasion into Gaza. I put the emphasis on some kind. We've gone from talking about a full ground invasion, Tom, to talking about operations. This is Ollie Krug on the ground for us in Tel Aviv, and that's a subtle shift over the last few days.
The subtle shift is there. What I noticed from Oliver that I thought was so important was the idea of the military separate from the politicians. I wonder how President Biden, with 2,000 rumored U.S. people involved in some way, how the president will address the Israeli military.
I would stress potentially involved, Tom. No confirmation about any of that right now, and certainly not combat troops. We should emphasize that fact too.
Right.
Tom, away from the geopolitics, 1, got the bank earnings, 2, the economic data, 3, and the way the Federal responds to it, 4. And you're going to get that economic data, TK, in about 28 minutes' time.
At the retail sales, Lisa, your thoughts on this? We've really underplayed it. We've just been wrong on this, and the answer is it's important.
We've seen resilience continually, and it has been driven by the American consumer, which is the reason why I think, to Megan Graper's good point, what is underpinning some of the rise that we've seen in the long end, despite some of the geopolitics that we've seen, is because of the strength, the unexpected strength that has continued. And if we see that in retail sales, how vulnerable is this market, ironically, not to some of the incredible tensions and tragedies, but to upside surprises in the consumer that causes yields to go higher and people to reset their expectations of Fed action?
I mean, John, help me with this. I mean, I got to dovetail the economics into the bond market, and the news flow is extraordinary. Every time I look at the Bloomberg screen, I see a bond market walking away. And there's doubt here that we could get to a higher yield structure on bonds.
In either direction. This is a small move these days. It's a 6 basis point move on a 10-year at 476. And we're trying to read between the lines in the bank earnings just what is happening in this economy. I was catching up with Shnali Basak over email as these numbers were coming through, asking the question, is Bank of America the Bank of America? Really think about that. Who are they serving here? Look at the average credit score of some of their clients, their customers, Tom. Incredibly high. Is that really insight into the broader U.S. economy right now?
And that shows over to Thomas Schode, who was with us earlier from Keefe, Bruyette & Woods. And the basic idea is there's a whole other banking industry out there. And that's where I'm most focused on, which is this roll-up of banking that we fought for decades and decades and decades. Is this turmoil right now the catalyst for bank combination? Lisa?
Well, what he said was really interesting, that if there is not bank consolidation that is signed off by regulators who have a history of slowing it down, that's going to make it even harder for smaller banks to compete with the larger banks that are dominating.
Got a great equity guest. I'm going to consolidate, John, to the data check. Swiss franc stronger today. It was not a jump condition, but something to note given the tensions.
Equities a little softer. Decent dev gains yesterday on the S&P. We pulled back by 0.3%. 0.2%. In the bond market, yields look like this on treasuries, higher by 5 basis points on a 10-year, on a 30-year, up by 6 to 491. At the front end of the curve, up by 2 to 5.11%. Going into retail sales, TK, that number dropping is just around the corner. Megan Grapen of Barclays, I think, really raising an interesting question. The message that was received from the Fed speak over the last week was that they'd allowed the bond market to do the heavy lifting for them, and maybe they're done. Megan's pushing back against that. If yields are climbing at the long end because the data's better than expected, then maybe they need to do more. We'll find out. And maybe you get more insight on that going into Chairman Powell on Thursday off the back of this print that we get very shortly.
We get insight from him, but the answer is the markets speak, and his log convexity to a higher yield is where we are right now until proven otherwise. This is without the question for this week. The interview for those of you on radio and television worldwide who are saying, forget the fancy talk common sense. Robert Dahl has decades of experience enjoying losses in the equity markets. He's at Crossmark Global Investments and is a needed conversation this morning. I want you to address the retirees, the institutions who are very 40 within the 60-40 split. You and I have never witnessed price declines in bonds like this. What is the to-do for the people that have been hammered in bonds?
As you know, if we don't get a nice rally in the bond market in the fourth quarter, it'll be the third year of losses for a 10-year Treasury. That has never happened before in history. So these people are sticker shock, shell shock, whatever the word is.
Do they shift to equities?
Look, depends on your time horizon. If you have a long time horizon, you're 65 and you're retiring and you're good health, you should have more equities.
See, always looking at me when he says that.
Well, you say, do you shift to equities? Let's dig deeper into that. Do you realise these losses in the bond market? That's essentially the question Tom's asking here. Or do you sit on them?
Yeah, so I don't think you run for the hills in the bond market. I don't think we've seen the high end yield. Look, you've been debating why are yields up. They're up because the economy's a little better than expected. Inflation's nowhere close to 2 and is stubborn. And you got the supply-demand thing that rears its ugly head every once in a while. That's not an environment to see a 3-handle in a 10-year Treasury.
And right now we're wondering whether bank earnings are indicative of the broader economy or whether they're an outlier at a time where they're consolidating their business in a smaller number of high-income individuals. What's your view? How much of a tell has the early earnings report been?
That's a great point you're making. That is to say, bank earnings are probably a little less useful than usual, a little less useful for overall earnings. Look, my big surprise, you touched on it a second ago, is we haven't seen more consolidation in the banking industry. Post the debacle in April, my thought was we're going to see more bank combinations, and there've been precious few. There will be more to come. We need fewer banks.
At this point, though, given the fact that you're still seeing credit extended in the economy, do you think, to put these two ideas together with the bond market, that bond yields could go even higher on the long end, and that actually Megan Graper is correct, and the bond market is telling the Fed they need to do more on the front end, and not that they have to let the long end do the work?
I agree with you. Is the long end doing some of the Fed's work for them? Absolutely, but that's proving not to be enough. The Fed, I don't believe, is done. We said all along, either November or December. I think it's more likely December. But I still want to come to the point, more important than if the Fed raises rates again, is what about the impact from 0 to 5.25 in the last 18 months? We have not seen the full impact of that, Lisa, and I think that's still in front of us.
Let's talk about the banks and build on the way Tom started this conversation. Many of these banks are sitting on some securities, very long dated, bought when rates were very low. Now rates are higher. They're underwater.
By a lot of money.
This is what Bank of America and the CFO is saying about them. Expect 0 losses from the held to maturity securities. I think we all understand that. What gets them out of the penalty box regarding this story? Because that stock has been bullied by this story all year.
Yeah, because they're big numbers and it's legitimate. Some banks had a mark to market, and we know what happened back in April. Look, these things will mature, and they'll be at a 0 loss at that point in time. But it's so big and it's so pervasive. I don't know how you can hide behind that and ignore it.
To your brilliant question, John, I'm sorry, you're 100% correct. The idea of held to maturity is BS in any textbook. You go to Lehigh University a million years ago, and young Dahl was going, That's baloney. Let's talk real baloney here. I want to talk about your CPA background and the fancy Wharton degree you've got, which is about accounting. The absolute shock of the gloom crew has been margin resiliency. That's an IMF term. Everybody's resilient. I was resilient over my Moroccan coffee. Are we resilient right now on our margins?
I don't think so.
You're going to see margins give way.
I think margins will come under some pressure. We're early in the reporting season, and they've held up reasonably well. But I don't see how companies can continue with these big price increases to match their cost increase. Look at the labor wage gains.
Okay, so are you in cash? I mean, this is the negative. This is the gloomy doll we're seeing today.
We have more defensive securities. I want securities, stocks, that have high earnings predictability, high earnings persistence, good cash flow, and reasonable valuations. And that means you're away from the economy to some degree.
That's Apple, Microsoft, and Manchester United.
Okay. Manchester United.
What are the names, Bob?
Those would fit the bill.
Not Manchester United.
Yeah, definitely. I double up on Manchester
right,
United. The HMOs fit the bill. Some software companies fit that bill. It's what are the companies that you're pretty sure 6 months from now will deliver the earnings that are expected? I think a lot of companies will miss on earnings as the economy slows. Whether we get a recession or not, that's escaped almost everybody's vocabulary. I don't think it's out of the picture for next year.
Walmart, present PE, almost a 30 multiple. I don't get it.
How many times this year have we heard about a weaker consumer?
All
How
year?
many times? We've said on this program, the economist that cried recession. Do you see it actually materializing this quarter? What are the sources of demand that's held up this economy that you can identify that are failing currently?
So the amount of cash on the balance sheets, the excess cash from the pandemic, that has definitely come down. We can debate whether it's almost over or still $500 billion or whatever, but it's not $3.5 trillion where it was. Two, we're starting to see fewer people work multiple jobs, and that's often a lead indicator into the job market. It's not a long list at this point. You have to look at the lead indicators for the employment cycle, and they are getting to the point now where 18, 24 months after the Fed starts raising rates, after the yield curve begins to invert, we just have no patience. Somebody went back and looked at these periods in the past between Fed raising rates, yield curve inverting, and the start of a recession. The dialogue is always, the recession, it's never coming. And then all of a sudden, there it is.
Jobless claims, coincidental indicator, saying it's not here, isn't it?
No, it's not here yet. That's correct.
Still in and around 200K. More jobless claims data a little bit later this week. Later this hour, about 20 minutes from now, we'll get US retail sales. Let's work through the price action, starting with the bond market. Yields are higher today across the curve. 2s out to 30s on a 10-year, up by 6 basis points at 476.68. On a 30-year, up by 7 to 492. On a 2-year, up by 2 to 5.12%. In the equity market on the S&P 500, pulling back after a monster day of gains on the S&P. We're negative here by 0.3%. Bramo, we've heard about it time and time again. The consumer slowdown is coming, it's coming, and apparently it really is this quarter.
Well, but here I think is the reset that we're trying to deal with. It's one thing to slow and to remove the engine of growth from the U.S. economy. It's another thing to slow from incredibly high rates that actually exceed last year, and we're normalizing back to something that still is elevated. And that, I think, is the subtle shift that you're seeing in the rhetoric from some of the bank CEOs so far.
What if we get a Bob Michael, Joyce Chang yield structure? If yields break out higher, based on what I just heard from
Bob was calling for them to drop to 3. If they
Yeah.
drop to 3 across the board, then that economy does not look good.
Yeah.
Let's put it that way. Bramo's asking the right question. We asked it of the banks. What are we going back to? Well, now VMH says it's the end of the post-pandemic luxury boom, or alludes to that. Bob, what are we going back to?
Yeah, that's a great question. And to underscore, the pandemic just took so many numbers and they made them weird and hard to interpret. But when you take rates from 0 to 5.25, there are consequences.
Yeah.
And we haven't seen too many of them yet. There are more coming.
LVMH, I think, was really misreported. They're actually doing pretty well, and their booze business didn't make it.
Down 14%.
Yeah. I think it was a lumpy quarter, and who might have say what LVMH should trade at? But the answer is it was about cognac.
You were away when we had this conversation.
Did I
The
miss
production
something?
team wanted to know.
I was having cognac.
We weren't well
Lamont,
positioned to
yeah.
answer this question. What is the trade down from Hennessy? Was the question that was asked.
Well,
What is the trade
I
down?
set it over my Hennessy
Hennessy.
at Lamonia Hotel. It was great. Red O'Keeper of the Amex cleared that.
I went to the Hennessy factory once.
Did you?
Yeah.
I went to the
tasting room.
No, I was too young to taste.
Oh.
Too young. My dad forced me into
17.
that trip. Yeah.
It was a forced
Went to,
trip.
it was one of those
It's-
trips.
it's good.
To the
Could be
vineyards of
worse.
Santa
Could be
Emiliano.
worse.
Yeah.
Horrible. Gosh.
Anyway, Bob, good to see you.
Deprived.
Bob Dole, thank you, sir.
Gonna go buy
Retail
some
sales
Manchester United.
later this hour.
Thursday, the Economic Club of New York hosts a conversation between Fed Chair Jay Powell and Bloomberg Wall Street Week's David Weston. Recession risk, inflation outlook, real estate amid high rates, and more. The live interview happens October 19th at 12 p.m. Eastern on Bloomberg. Context changes everything.
These banks are actually making a lot of money right now. They're making a lot more in net interest income than they did last year. Trading has been resilient. Investment banking is cyclically depressed but could bounce back. And so, a lot of these banks understand that you can't necessarily cut your way to glory.
That was the view from Erica Nigerian of UBS, going to the numbers we just got this morning from Bank of America and Goldman Sachs. Coming up tomorrow, Morgan Stanley, just to check in on the price action on the S&P 500, negative here by 0.3%, a little softer, yields higher by 5 or 6 basis points, 476. I should apologise to lovers of cognac. It's a distillery and not a factory. I know.
Oh, very good.
Oh, come on.
Just,
Did someone correct you?
very
Someone
good.
corrected
Just heard
you.
my mum's voice in my head. Some people really appreciate this
You've
stuff.
been raised right. I have not. Carry on.
Let's get to those two names in the pre-market, Goldman Sachs and Bank of America. Goldman out with numbers in the last couple of hours. Fixed sales and trading revenue, 3.38 billion. The estimate, 2.86. Third quarter revenue, 11.82. The estimate, 11.13. A series of small upside surprises from a couple of these banks, Tom. Bank of America up by 0.9%. Dreadful year for that stock. Goldman Sachs up by about 0.1% this morning.
It's interesting to see, and we're going to continue this story forward right now. Srinath Rajan joins us, owns the high ground on the major banks, and particularly Fortress Solomon, or at least Igloo Solomon, as it is. Let me just go to a general and open question right now. Your thoughts. I'm looking at different stories here saying it was a moldy quarter because of the write-downs. But your thoughts, Sri?
Not necessarily because of their pullback from consumer lending. It was a moldy quarter. This is, again, a transition quarter. We talked about the second quarter for Goldman Sachs being a kitchen sink quarter. They are doing the strategy pivot. They owned up to their mistake with the consumer banking foray and lopped in a lot of the losses and the hits from backing out of that in the second quarter. Some of it is reflected in the third quarter as well, but a lot of the losses are also just straight tied up to the real estate market and also the fact that the investment banking market remains sluggish. That's what's driving profits down 33%. Not necessarily some of the changes you're seeing there. They're significant from a strategy perspective, not necessarily a third quarter earnings perspective for Goldman Sachs.
What is Igloo Solomon, TK?
Smaller.
Oh, okay.
Smaller,
I thought you were saying
more
like icy,
focused.
cold.
We have
All right,
Fortress.
please ask the question.
Fortress.
That's what you were going, right?
That and it was melting.
Fortress is like big, and we're doing this, and we're doing this. It's what Jane Fraser wants to do. These guys want to. Can we just get back to what we used to do in a smaller format?
Okay, good to know. Just
Did I
wanted to
do
clear
okay
that.
there?
That was
Thank you.
wonderful.
Thank you.
Go on, please.
In my mind, a Fortress is also a lot more sturdy than an Igloo.
Okay, you're both digging, aren't you? Are you saying that things are sturdier at JP Morgan right now than Goldman Sachs?
I was just trying to explain what Tom Keene is saying.
Okay, we're all trying.
Good luck with that.
I'm making a career out of that.
Save us, John.
Okay, of the forces that have held this bank back, are things getting better or worse?
It's headed in a new direction. Not necessarily better or worse, because they will have to execute. It is a story that they have to tell. They have a coherent story to tell now. You could argue that there was some flip-flopping over the last couple of years, but at least now it's clear. They say they have two important legs to the stool, the investment bank and the asset and wealth management unit. Now the key is to prove that they can deliver on both fronts to the expectations of investors and therefore drive the stock higher with higher multiples down the road.
What can we learn from the fact that Goldman Sachs beat on equity trading revenue at a time when we saw JP Morgan and Citigroup not?
It's interesting. Look, over the last few years, the crown for equity trading champion on Wall Street has been moving around between Goldman Sachs, Morgan Stanley, JP Morgan. It was pre-pandemic, at least for a few years, unquestionably Morgan Stanley. Not so much post-pandemic. That comes down to some credit you have to give to Goldman traders who have gained serious market share across equities and FIC. Bank of America had a big jump in their equity trading business, but that was off a lower base. Goldman's jump from $2.6 billion to $2.9 billion in a quarter is pretty significant. If you can hit $3 billion a quarter in equities, that's a pretty sturdy business.
What's the difference between market share gains and riding a good market, right? A lot of people have raised questions about how robust capital markets are right now, given the fact that a lot of companies are icing a lot of their transactions. How much is this just market share gain from European banks, from smaller banks, from each other, rather than really reflective of a good environment?
Riding the gains is a factor of the overall wallet. An individual bank does not control that. But what they can control is the market share of the wallet that's available. And if you are gaining market share there, you're making progress. So even if the entire industry moves in a certain trend, if you're gaining within that, you will stand out, at least in the eyes of investors.
Sri, not everyone's a bank analyst. There's some people listening to this and hearing phrases like how-to-maturity securities and all of this stuff regarding Bank of America. The stock's in the penalty box. It's down close to 20% year to date. Can you explain what is going on? Those longer dated securities are underwater. We can all get that far. What's it stopping this bank from being able to do that is punishing this stock so much?
The punishment in the stock simply goes to the fact that because they made that move, because they plowed their excess deposits a couple of years ago into some of these longer dated securities, that with the moves in interest rates that we've seen have been underwater, has meant that their securities portfolio is down $131 billion. That doesn't affect their earnings, but it does affect their earnings potential. Right? If they had not had this money locked up there, because it's all in held for maturity right now, if they didn't have that money locked up there and earning 2.5%, it could well have been earning 4.5% and 5% in a 5% world.
Okay, this is brilliant. And I got like 8 questions and we don't have time. What is the maturity right now? What is the average maturity of their under $0.1 trillion?
See, this is what I said about trying to decipher Tom Keene. It can be very tricky, and sometimes you just end
What's
up
the
without
average
an answer.
maturity here?
You got me there, Tom.
We don't know. Does Michael Barr know at the Fed?
I'm sure he does.
Oh, why don't we know? Why I don't understand why shareholders don't know the average maturity of any given bank's held-to-maturity portfolio.
They do break it down. If I pull up the results, I can probably figure out that number for you.
The distinction that Sri's making, Tom, is really important.
Yeah.
This isn't about selling those securities at a loss. It's about earnings potential, which is why I really wanted to break this down. So when they come out and they say things like, we will have no losses realized on these securities, that's kind of meaningless, isn't it? Isn't it just that your earnings potential relative to, say, JP Morgan is that much lower?
If you have a $400 billion securities portfolio, let's make up a number here, $500 billion securities portfolio, and you're earning 2.5% instead of an average of 4.5% on that, that's a 2 percentage point difference, and that's a $10 billion earnings difference. That adds up, and that matters. That's the reason the stock's down 20% this year, was down even more last year, and that's not a good look over a near 2-year period.
When it comes to earnings potential, though, we're not talking about extending loans for mortgages. Thomas Show of KBW on earlier saying that they've gotten out of the game pretty much. How much is this just simply being able to capture the differential to current market yields on safe loans to high-income people versus the beta of what you've got to pay to depositors, which is basically nothing?
If they were down 5%, if they were down 8%, and we're talking about how do they get to being down 4% or being flat for the year, that's the latter is what we're talking about. The reason they're down 20%, way worse than every other big US bank out there, is largely down to this earnings potential because they are missing out, plain and simple.
One final question. Does David Solomon have the support of the board? Within your reporting, I give him very high marks for managing this, as you say, kitchen sink over to another quarter, but does he have the support of the board in this process?
We don't have to guess on that front because last month, Mike Mayo was able to extract a public nod of support from the Goldman Sachs board lead director saying he's not going anywhere.
What's Montag doing?
Montag's there digging into numbers and clearly backing David Solomon.
This has felt personal for, I would say, the whole year so far, hasn't it? It's felt personal within the bank. I don't hear complaints from investors like we've heard complaints from sources within the institution.
Undoubtedly, there was dissatisfaction in the ranks. You can't get away from that. Part of it is Goldman screwed up on one front. Goldman Sachs prides itself on excellence and, in fact, risk-taking, and they have very little tolerance for it. But now that you're through the other side, now that you've copped up to your mistake, now the story is, do you then move on, or does the rank and file still demand consequence?
They're trying to move on. Sri, thank you, sir. Sri Natarajan there of Bloomberg on Bank of America and on Goldman Sachs. Coming up in the next hour on Bloomberg Television, this is the lineup. Colin Martin of Schwab, Francis Donald of Manulife, Max Kettner, HSBC. It's been constructive most of this year. Let's see if that changes. Stephen Bigger of Argus Research on some of the financials as well, Tom. Stack lineup in the next hour on Bloomberg
Really
Television.
interested in Max Kettner. Really interested to see how he's adapted and adjusted.
That conversation, 9:30 Eastern Time. Coming up shortly on this program, U.S. retail sales. Big data point for this market. Let's see if consumption in America holds up. Equities down 0.2%. Yields higher 5 basis points. Your 10-year 4.75. Your data up next from New York. Good morning.
It is 70% of the American economy. Retail sales, it is reported nominally with inflation in it. Michael McKee is, of course, very expert at this. And he understands there's retail sales, and then there's X this, X that. All the X's are in there.
All the X's, and then they're out of them.
They're there,
Auto,
and there's
gas.
the Retail Sales Control Group providing wisdom on the pulse of consumer America. Michael McKee.
All my exes live in Texas, as they say. Well, retail sales come in much stronger than anticipated,
Actually,
up
they do.
0.7%. That's more than double what we had seen
Terrible
forecast. X autos up 0.6, and X autos and gas up 0.6. So the Retail Sales Control Group, which is kind of the proxy for what goes into GDP, is up 0.6 as well. And the forecast was for just a 1/10 gain. Very quickly note, New York Fed services businesses report a lousy month, down 19.1 from 3.0. But it's the retail sales number that's going to catch everybody's attention today. And the interesting thing is how strong it is overall.
Let me do a market check.
Yeah,
Mike, dive
sure
into
you're
that
going to
data
get a
right now.
market
Mike
check.
McKee's going to dive into pages of data right now. Greg Dacre is going to be with us in a moment. But there's no other way to put it. There's a massive move, maybe a bigger move than Jobs Day that we saw a number of days ago. At least equity south and the yield market launches, to say the least.
Megan Graper nailed it. If this is ongoing, stronger than expected economic data, the front end is what is moving. The idea that maybe the Fed needs to do more than they previously thought.
And the revisions just out moments ago. Michael McKee, let's come back to the markets in a moment. Mike, this is too important. You've got 60 days of lift.
Really strong lift, because the August number revised up to 0.8 from 0.6. The August Retail Control Group revised up to 0.2 from 1/10. So a lot of strength in retail sales over the last 2 months. Now, in the month of September, what we're seeing is a gain in motor vehicle sales of 1%, which is a little bit interesting. Of course, they calculate this differently than the seasonally adjusted sales number for auto sales, where they count units. This is dollar value. Electronics were down 0.8. That's the big loser, along with clothing and accessories, which is kind of interesting because it's back to school time still, I guess. The big gain on the month is, I'm looking here, is, well, gasoline's up only, is up 0.9, but that's not the big gain on the big gain on the month. Non-store retailers and miscellaneous store retailers.
Okay, Lisa, the
so
markets.
we're getting some Amazon, Walmart business done there. And food service and drinking places, Tom Keene keeps the economy going, up 0.9.
There you go. A boom economy. Lisa, the markets are really moving
What
on
we're
this.
seeing in particular, just yields again going higher. Earlier on the 10-year yield, we were up by about 6 basis points. Now we're talking 8 basis points, a normal move over the past couple of weeks, considering how much they've been fluctuating. But what the implication here on the front end is that maybe the Fed hasn't done enough. And Mike, I'd love your thoughts as we parse through all of this about a couple of misnomers, whether we're not actually seeing consumer price pushback on gasoline, that it's not actually crimping consumer demand as much as we previously thought, and that services spending still continuing to accelerate in a way that people didn't expect.
Well, you don't get a lot of services numbers in the retail sales report, really only the food services and drinking places. But that's kind of makes this even more surprising, because you don't expect such a big increase for basically buying goods. Goods sales have been dropping somewhat compared to services. Now, the Fed Have they done enough? That's going to be an interesting discussion for them, because is this really a continuation of we've got pandemic savings and we don't mind spending? Is this a sign of real strength in the economy that will be inflationary? Now, Tom mentioned at the top that you have to deflate these. And durable goods inflation was down 0.4 in the last month in CPI. So this is perhaps even stronger than it looks. So it is an interesting question for the Fed.
What will these do to market economists' GDP guesses for this fourth quarter?
Well, definitely going to raise GDP guesses and probably the CPI now number from Atlanta Fed, because this is just much stronger consumer spending than anticipated, and it is the last month of the quarter, so hasn't been incorporated yet.
Stunning. Michael McKee, thank you so much. And again, the market's still really pricing this in. I look at just simply the red and the green blinking on the Bloomberg professional service, and it's still going, Lisa, here. We're at 834.31, and the screen is still adjusting.
And the move is bigger on the long end than the short end of the bond market. I am focused on the bond market in particular because that has been driving so much of the action. And I find that interesting, considering person after person who says the front end is pinned. Is it? Or are we looking at something
that's a really,
that is
really
an economy
good point.
that has that much more momentum than people thought?
2-year 5.15%. I'm looking at 2-cent spread, 4 points of disinversion here to 35 basis points. And the real yield just moments ago rounding out to a 2.40%. That really bears watching. Greg Dacko joins us now. Chief economist, EY, as he considers this across all the advantages of the EY system. The market was surprised. Were you?
Yes, I think the surprise was both in terms of the strength of the data in September, but also, as you mentioned, the upward revision for the month of August. We are seeing that consumers spent more than we initially thought over the course of the summer. The key question is twofold. One, do we see that momentum persist into the fourth quarter, or do we see a little bit of a pullback after the strong summer? Two, is it inflationary growth? To your question about whether the Fed will have to go further in terms of raising rates. So far, we haven't seen the type of inflationary dynamics that would be aligned with this strong growth. I think that would allow the Fed to not necessarily have to tighten further.
Are we in the thrall still of pandemic uncertainty? Do you have a belief to Q4? Can you model out Q1, Q2 of 2024? Or are you just making it up because this is a regional macroeconomics?
Well, I think it's very difficult, certainly, to forecast in the current environment. We have a set of unique features when it comes to the state of the labor market. We have a set of unique features when it comes to the state of the housing market. When it comes to the resilience of consumers, even, we've been surprised as to how resilient consumers are. But I would note a few things. First, we are seeing the drag from higher prices weighing on consumers' ability to spend as we move forward, especially for lower income families. We're seeing the weight of higher interest rates weighing on people's ability and desire to spend on credit. We're seeing tightening credit conditions, and we are seeing the effect of tighter financial conditions even today.
Okay, this is what people have been saying. Fed officials included in anecdotal conversations that they've been having with their constituents. They're hearing about this. So then why does the data keep coming in stronger than expected, read after read?
Well, again, this is still the third quarter, right? We had a strong third quarter. We know the spending in terms of consumer activity was very strong in the third quarter. We also know we're not seeing a retrenchment. That is one of the key elements of this economy. We're not seeing the business sector retrench, whether it's in terms of investment or hiring. That is still supportive of income, and in turn, that has allowed consumers to spend. The key question is whether this type of momentum, very strong momentum in the third quarter, can really persist into the fourth and into the first of next year.
You said something that was really important, that it's unclear whether this type of spending is inflationary.
Yes.
What is going to be the tell on that? Because it seems like if people are willing to pay higher prices and companies are passing them along, akin to Pepsi or Coke, and you've got shrinkflation and all that, well, why wouldn't this be inflationary? Why would inflation keep dropping?
Well, we've continued to see slower momentum when it comes to CPI prices. When it comes to PPI prices, even the margins on the PPI front are pointing to less inflation on a sequential momentum basis. Even the jobs report last Friday that was very strong was non-inflationary. We were seeing the help from the supply side help alleviate some of the wage pressures and bring down wage growth. So that's less inflationary than would be concerning for the Fed. And we've seen actually inflation run ahead of the Fed's expectations, I wouldn't be surprised that we end up below the Fed's SEP projections in terms of inflation by year end.
Greg Dacre of EY, where this will continue here, 5.15% in the 2-year. The 10-year yield really buttressed out right to recent highs, 4.80%. 30-year bond a dash to 5%, 4.94%. Michael McKee, a further observation.
Well, I think the auto sales is an interesting situation, and we don't know how much of that is parts and repairs, but given the fact that we had a strike and maybe that got people to go buy cars while they thought they could. But at 9:15 this morning Eastern, we get the industrial production numbers, and we'll see about auto manufacturing to see if that is a sort of counterweight to the auto sales. If we're just selling what's on the lot and you're not going to have any more, then that is less of a problem for the Fed. But it's an interesting dynamic.
Yeah, but Mike, for 4 years, we've simply misguessed the resiliency of the consumer. What are the economists doing wrong?
It's an interesting question, because we always used to say before the pandemic, never stand between an American and a cash register. And that seems to be back in force. There was a shift in spending. Everybody went to goods during the pandemic, and then everybody did revenge travel and went to services. And now it seems to be broadening out so that people are just continuing to spend. But we thought that their money would run out, and it hasn't. It may be the additional wage gains that people have gotten, because people tend to spend what they make. And now if we've spent down the pandemic bonuses, it may be that people got raises and they feel like they can spend more.
Greg, just final word here. Does that mean that this world can live with 5% benchmark rates, and that we're looking at a new term structure that looks very different to what it did 3 years ago?
Well, we certainly have to adapt to a higher cost of capital. I think there's no doubt that we have to have both the business sector and the consumer sector adapt to this higher cost of capital. I would point to one thing that is very important in this higher cost of capital environment: how strong income is. If we start to see softening in income, which we have seen, that will weigh on people's ability to spend. But there's no doubt that we're not going back to the free money era. People still want to invest in this environment, but there's going to be more scrutiny as to how much investment goes into the economy and how much hiring goes in.
We wrote a final quick question. Which matters most, the November meeting, November 1, or do we dash to December? Which meeting is of greater value to Greg Dacre?
I think both meetings are going to be quite interesting, because even if we don't get a rate hike at the upcoming November meeting, we'll get a discussion and more information coming out of Fed Chair Powell as to the intentions of the Fed going into the last meeting of the year. They will want to maintain that optionality of one more meeting, but I think they're increasingly taking comfort in the fact that the July rate hike may have been this last rate hike in this historic tightening cycle.
Interesting, Tom. We see the November meeting hasn't changed in terms of futures pricing, 9.8%, but now we're up to 31% for December.
Exactly. I think maybe this is the moment where we launch out to, I believe it's December 13th. Greg Dacre, thank you so much.
Thank you.
With EY, Ernst & Young, of course. Futures at negative 18. I got to do a complete data check here. I'll do it equities, bonds, currencies, commodities. Negative 18 SPX futures. VIX comes out, not a stick, 17.95. Yields, as Lisa said, 480 on the 10-year yield. We're on the 5% watch. 30-year bond, 4.94%. Brent, 89.77 as the president travels to Israel. The Standard & Poor's 500 down 0.4%.
If you are just joining us, really, we did get these retail sales number that came in completely above expectations, 0.7% month over month versus the expectation for 0.3%. But Tom, to me, it's also the upward revisions of the prior month, as Greg and both Mike and Greg were talking about. This idea, it is a trend. If you say one number can't make it, it is not just one number. It is a couple of consecutive, really stronger than expected reads.
And then we mentioned this earlier, the charge card delinquencies, the auto loan delinquencies for the younger cohort, to me, are spike conditions. They're shocking. And I'm going to go back to the analysis of two Americas, which goes back to what you and John were saying about who is the Bank of America client. And there could be other banks we can talk about. But to me, it is a struggling America. And you and I anecdotally feel that every day with all of our contacts. And then it's another America that just seems to be impervious to this. And as Neil Dutta says, it's rising incomes.
Patrick Harker said the anecdotes were the leading indicators for him at a time of great uncertainty heading into the inflationary spike. At this point, those anecdotal comments about that weakness, about the pain that a lot of people are feeling, Is that a leading indicator? And have we just not felt it yet? I think that's one of the biggest tensions right now underpinning some of the commentary from the C-suite and, frankly, from investors right now pretty broadly.
And it says, say the least, I guess, to November 1. I mean, tell me we have more Fed speak to explain all this to me.
Oh, we do, Tom.
Yes.
We have a lot of Fed speak.
to do what he does like
Yeah,
Billy
he's
Joel.
going to do the rap. Oh, yeah, he's going to do We Didn't Start the Fire.
Yeah.
You got a lot of response to that.
We
I think
didn't
people
start
like that.
the FOMC or something like that. Futures at negative 18 coming up. Good friend David Malpass. He is emeritus at the World Bank. Bramo's going to grill David Malpass here. Stay with us. From New York, this is Bloomberg Surveillance.
We calculated the cost of fragmentation just on the issue of trade. If we do it well, in other words, we strengthen security of supplies, but do it wisely, not willy-nilly throwing the baby with the bathwater.
Right.
The cost would be minimal, 0.2% of GDP. If we are reckless, it can go all the way up to 7% of global GDP.
That was Kristalina Georgieva, IMF Managing Director with one Thomas Keene over in Marrakesh last week on a fantastic panel. Tom, I'm glad to say, is back with us, but it was really terrific to hear some of the angst really underpinning those discussions about debt interest costs and also about fragmentation more broadly and a lack of consensus around how to spend.
There was a financial side to this. Think Tobias Adrian and all that's going on in the bond market, and there were the usual words. The bartenders were resilient. I mean, everybody's resilient right now. Here's the bottom line. There's two worlds out there, and the World Bank, Lisa, didn't get enough love because the Icahn Green paper at Jackson Hole said there's debt out there and EM's getting hammered, and that's a World Bank province as much as an IMF province.
And we have an incredible guest to talk about that coming up, but I do want to just tell you, talking about the have-nots, the haves are the ones that are banking at the Bank of America and Goldman Sachs, and that's what we're seeing right now, with Bank of America climbing out 1.4% gains. And we were talking earlier, Sonali Basak pointing to the incredibly high FICO scores of all of their creditors. And this really points to, are they really a reflection of America or not in terms of the pain, et cetera, being felt by the lower income quadrants? Goldman Sachs shares basically flat after beating on the core business of investment banking, but maybe not giving complete clarity going forward.
Real yield measurement here, 2.49% was the apex, as they say, about 10 trading sessions ago. We're up nicely on the 10-year real yield off a buoyant retail sales revision in all. I'm sorry, this is good news for America, even though the people in suit and ties will say it's just terrible.
Is the good news for America in terms of consumer spending coming on the heels of bad news for fiscal responsibility? And this is sort of one of the angsts underpinning some of the longer term yields and how much they've risen. Joining us to help parse through exactly this question, David Malpass, former president of the World Bank, here with us in New York. David, to that question, how much are the buoyant retail sales, the resilience of the economy being financed by a increasingly fiscally irresponsible government, not just in the U.S., but globally?
Yeah, this is a huge factor because as they pump out money in terms of spending, not just the fiscal deficit, but all of the spending has to be added up, and it's material within the global economy. So they're an engine of demand that's sitting in the U.S. You know, we're talking about $2 trillion per year fiscal deficit. It used to be after a crisis like the COVID crisis, you would bring down the fiscal deficit, but this time it's gone up and plans to go up even more into the future. And so that has to be one explanation. That was my Wall Street Journal column a couple weeks ago, the idea that as you try to raise interest rates, it doesn't really get at this part of demand.
There's also a question about how much of some sort of united effort there can be by global developed markets, by governments that are not on the same page anymore in the same kind of way. How much is there sort of a go it alone, keep borrowing until you can't anymore feeling that wasn't there, say, 10 years ago?
Clearly, during COVID, there was an official policy of the of IMF, of ECB, of the U.S. To spend as much as possible, and a lot of the developing countries did that. They borrowed at floating rates. So now there is the need for adjustment. There was talk on your previous segment of whether 5% interest rates is sustainable. I find that I'm really skeptical of that, because if you think of the whole concept of finance, it's based on a return on investment. So if your riskless rate is 5%, what possible projects could you be doing that are going to return more than 5% over a period of time? It doesn't add up. So we have to get to a spot where there can be lower interest rates. I think that requires a lot more downward pressure on prices from production. So the whole question mark variable is how much energy production is going to be done in order to make up for all these deficits. You can't run the world economy on $85 a barrel oil with a hostage crisis going on. That's not going to be sustainable.
Yeah, this is fascinating. There's a David Malpass World Bank president who had a certain aura about him. And we've got sitting here the Bear Stearns David Malpass. We're talking here an immediacy and it changes as you come out of the World Bank into the private sector. Again, there have been David Malpass fears for years. I don't see the politicians agreeing with you in Washington, Brussels, London, the rest of the capitals around the world. It's spend, 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 David. How do we get here?
Yeah, but the capitals are really resistant to making any changes in the growth of government. So in each of the cities you named, those cities are booming while their countries are not doing nearly as well. And that goes into the Federal Reserve policy, which I've also complained about. Look what we've done. We've gone from 0% interest rates now to 5%, and people are 5.5%, and people are saying, well, we might just keep them at 5%. It doesn't make any more sense.
Is it a policy for elites? Is that what this is all about?
It's a policy for elites. Yeah. Think of how much money is made when you go to zero. Wall Street and the financial markets get really rich on 0% rates. Now, as you adjust, they've locked in their low rates, and everybody else is paying floating rates. So it doesn't make any more sense to talk about high for long, interest rates for long, than it was for low for long. Why did we go year after year with economists saying low for long is great for the world? It wasn't. It allocated capital to narrow segments.
I'll take your point on that, but this is critical now. You were discussing, as you have for a generation, David Malpass, the idea that this is a policy for elites. When we clear that, do we clear it with stability and controlled glide paths, or do you see jump conditions and instability here?
That's yet to be seen, and it depends then on where it settles out. So if oil prices stay at 85, I think that ends up forcing the Fed to keep the rates long. The wealthy are able to adjust to that, and they preserve their capital. If you could get oil prices down, it would be an effective response to Russia, to Iran, to the power that's growing outside the United States. So that becomes a critical issue, just like it was, I hate to think back in history, but in the Reagan administration in 80, 81, 82, the critical turning point was oil was plunging as markets resolved, and then you got a favorable recovery.
Right now, we seem to be further and further away from the reality that you're putting forth as the likelihood for some sort of easy resolution to what we're dealing with right now. It seems like oil prices are on the brink of actually a breakout higher as a result of the conflict in the Middle East. Just how vulnerable is the global economy if it does go to $100, $110, $120 a barrel?
It's a dangerous world, and one problem here is the U.S. won't be the one that feels the brunt of it. So you see the resilience. The fiscal deficit can keep going on. They're planning to do it for another 10 years. And so the U.S. keeps going, draining capital from the rest of the world. And then you see these wars breaking out in one country after another. And China and Russia both know exactly how to put a wedge into that problem.
I got to slip this in. Joyce Chang of J.P. Morgan was lights out at the panel on the bond worries to EM. How fragile is EM debt in EM currency stability right now?
Really fragile. And so you see currencies in Nigeria and in Egypt and in other countries under pressure. Of course, Argentina having its currency dive. And so then it becomes really important. Do central banks realize that currency stability has to be their guidepost for recovery? That was the learning experience, I think, from the Asia crisis in 1998. The currencies were crashing, the countries were doing terribly, and then one by one, countries stabilized after that.
Eric Martin wants to know, our great IMF World Bank reporter, are you going to show up at the spring meetings, David?
I'm really focused on global benefits for people around the world, so I'll do whatever I can to help.
Good. That's it. Mel Pass, an invitation to the spring meetings. Thank you so much. The former president of the World Bank, and just wonderful for decades at Bear Stearns as well. Lisa, boy, was that a spirited conversation about the free lunch we're all getting from this fiscal stimulus.
The free lunch and the uneven ground in terms of the developed markets and the ability to keep borrowing and spending and the inability for the rest of the world.
We'll have to see. It has been the news flow has been just absolutely extraordinary. Balance of power this evening, of course, as the president prepares to travel to Israel and all of the Eastern Mediterranean as well. This afternoon, 2:15 p.m. on Bloomberg Television and Radio, our David Weston in conversation with Brian Moynihan, the Bank of America. Good morning.